I think it's very tough to take what Powell said and to say risk on.
There's a huge amount of uncertainty out there.
I don't know that inflation is a one-way trip up and a one-way trip down.
It does look like maybe some of the biggest, most aggressive inflation on the good side has come off, but we still have this services inflation.
People have either put themselves in the transitory camp or the non-transitory camp, and the reality is we have some of both.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We've got to start in Europe today. Credit Suisse, that is absolutely brutal. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures doing okay, but TK Credit Suisse anything but. That stock is negative by almost 10%.
Familiar story for Global Wall Street. I think we need to explain to everybody on radio and television what the so what here, John, is. And the so what, as we were talking before we went to air, is this has been truly an over-decade soap opera. The first thing is, what is taking so long to straighten out this venerable institution? And then with the outside investors coming in, mostly Saudi Arabia and Qatar money, who's going to put them out of their misery in some shape or form? That's the other big mystery.
To your point, Tom, this is a conversation that goes back to Brady Dugan. We've been doing this now for the best part of 10 years plus. So the news for Q4, a loss. The news for 2023, a substantial loss is incoming. And maybe in 2024, how about this for a line? These are just things you never want to say as an established bank. By 2024, I think we should be profitable. Lisa, what do you make of that?
That was exactly the quote that I picked up on. No one wants to say that as the CEO. I think perhaps we'll make some money in 2 years or a year, right? This isn't exactly an encouraging kind of sign. How do you bring back investors at a time when the competition for wealth management is so hot? How do you bring back that confidence after, as Tom said, a decade of the same kind of debacles? I'm
going to give them major marks, John. They put out 3 PowerPoints. I went through the 20-page fixed income deck, which is very advanced. There's some real sophistication there. And, it's got the usual cheerleading on page 1, but then they really dive into the troubles. And I love what they say. They had an October idiosyncratic events.
Oh, is that right?
They happen at the Baramo household every once in a while. But they actually use the language idiosyncratic events. It's not that they're in denial on it, but they're struggling to explain what happened. And then the other idea, in a wonderful deck on their ratios and their ability to be a sound Swiss bank, they point out the timeline of crisis, and they're not to crisis yet, trading under 3 Swiss francs. The point of non-viability, it's out there. You and I, Thursday night, we went out for beverages.
Sure.
We reached the point of non-viability.
Was that right?
That was
how deep were we into the evening at that point? Is that how deep they are into the evening?
It has something to do with Tottenham.
We all know some supremely talented people that work at this bank.
Yeah.
I'm sure many of you at home know some supremely talented people at Credit Suisse as well. How do you retain talent, Lisa, when you're cutting the bonus pool by 50%?
Right. And this actually is going to be an ongoing issue, because if you can't retain the talent, how do you draw in the flows? And it becomes a self-fulfilling spiral of idiosyncratic events, right? So this is the real question. How do they chart a path forward to give not only their clients confidence, but also their employees who are supremely talented at a time when there still is a lot of competition? It's not, yes, there are cuts, but there still is a lot of competition.
We played this game with Deutsche Bank how many times?
Yeah.
You can't cut your way to growth. Can you cut your way to profitability?
Well, maybe Deutsche Bank is saying, come on, guys, keep going, because they're collecting a lot of the flows,
seriously.
right? We saw that from their
I have trouble
earnings.
comparing them to Deutsche Bank. They're both in the same level of crisis, but to me, this is much, much worse.
You think it's much worse than Deutsche Bank a couple of years ago?
Buried in the footnotes, they show the equity salvation after October from outside investors, and I think what's going to be interesting today and into the coming days is where's the next tranche of cash come from for ownership, including Mr. Klein taking what I believe was a full convertible funding. Basically, it's paper for down the road when he saves the bank.
I think this is a message the CEO wanted to send this morning. 98% of our clients stayed with us. I'm not sure that's a message that's resonating at the moment. This stock is down and down hard. The broader market, though, is doing okay. Equity futures on the S&P 500 up 0.9%. Yields in a couple of basis points. Your 10-year, it's a break of 360 at 358.99. A little bit later on, Tom, we'll get jobless claims. We're looking for maybe a little tick higher to 190K.
But we said that for the last 6 weeks.
190K, TK. Put that in perspective for us. 190,000.
The 4-week moving average is what I use here of the weekly data, and the answer is it's at a place where experts stammer. They really don't understand it, I think is the safe way to put this. An unemployment rate that goes back to 1969. And you had that great, I'm going to say Gallup, you correct me, that great survey yesterday that half of America's flat on their backs.
I believe it was a Gallup poll, yeah. Lisa, looking ahead to jobless claims, 8:30 Eastern Time.
You really frame it well. This really is going to be important because a lot of people are questioning this idea of immaculate disinflation that seemed to take hold of markets to start the year in the face of such strong labor market data. 8:30 a.m., just to give you a sense of the trajectory over the past 2 years of just incredible downward momentum in the number of people looking for unemployment benefits. What is this? Is this an aberration, or is this really a highlight that really shows just how strong the labor market that we saw on Friday really was? At 1 p.m., and I mention this not just to tweak Tom because he hates when I mention the auctions, but because yesterday's 10-year auction was really interesting. U.S. is planning to sell $21 billion of 30-year notes today at 1 p.m., and this follows yesterday's 10-year auction that took the lowest proportion of primary dealers taking down the notes going back in history. Basically, there is so much demand for 10-year treasuries at 3.6%, which raises a question of, are they seeing a disinflation that does stick with some sort of terminal rate? Or is this a head fake? Is this just basically the amount of money that is in the system? And this is something that a lot of people are looking at for potential stability in the rates market. And aftermarket, we do get a host of earnings, including Lyft, Expedia, Yelp, PayPal. We're watching Lyft, especially after Uber. We're getting earnings this morning. We just got Pepsi, better than expected. Again, a motley picture. But what I'm looking for, John, and the reason why I pointed to Lyft, was consolidation of market share. How much do we see that ongoing as the bigger get bigger even still and are more resilient during a period that is really choppy?
Looking forward to some of those reports a little bit later. Bramo, thanks for that. I'm happy to say that joining us now is Ben Laidler, Global Market Strategist at eToro. Ben, before we get to the broader market, I want to start with the European banks. Is this a Credit Suisse problem, Ben, or is this a European banking problem?
I think it's a Credit Suisse problem. Banks in Europe have been some of the strongest performers off the bottom. I mean, remember, European markets, a lot of them are now hitting all-time highs. Banks, very, very long way from that. They all trade a fraction of book value, but they're loving this environment. They've been beating earnings expectations. I mean, it's a sector with some of the biggest earning beats this quarter. And you're seeing a lot of earnings momentum here with the ECB hiking interest rates aggressively for the first time in over a decade. So I think banks are a great place to be, even if Credit Suisse maybe isn't.
Ben Laidler, good morning to you. Our London desk has a terrific Ben Laidler-like article today showing the trend of where everybody's ripping up the script on a great bear market. And as you and I know, the trend followers get on board first, and those with the theory, those with the structure are delaying. They're still very cautious. They're really not committed to any form of upmarket as you have been. What is the process, the when-ness of when not the trend followers, but when everybody else climbs on board the Laidler bull market?
Probably just time. I mean, I think it's a recognition that the fundamentals have actually changed here. They may not be great, but they've absolutely got less bad, whether it's the easing interest rate and inflation shock, whether it's the lower bond yields, whether it's the reopening of China. And that's come against your point, this very attractive, from a bullish standpoint, technical backdrop. It's been a massive pain trade. You've basically had almost no fund inflows this year. Your cash levels are 5-6%, depending on where you look. Short positions, very, very high. And that's been the sort of gasoline on the fire, if you like, of these sort of less bad fundamentals. And that sets you, that's very positive from here, because one of two things is going to happen. Either the fundamentals are going to keep delivering. We've got a big inflation number next week, in which case I think some of these bears get pulled into the market, or markets, inevitably, we hit a bump in the road, markets come off, and even then, I think the bears are sort of newly sensitive here and take advantage of that.
Ben, you said that if we get a big CPI report next week, that will bring the bears back into the market. That actually goes against what a lot of people think, where if we get a big CPI number, that people will actually get scared, that central banks will have to tighten even more. What makes you think it'll be bullish?
Yeah, no, sorry. I guess I meant a good CPI report, which, again, will just increase this sort of pain trade, increase this sort of turn up in the fundamentals. And again, pull people back into the market. But I think they're coming back either way, because positioning is pretty extreme here. So either they drag back into the market because they buy into the less bad fundamentals, or just from a risk management standpoint, this 15% rally you've had off the bottom here for the S&P 500, which has been even more dramatic than the rest of the world, I think has been a sort of brutal risk management reality check to an awful lot of investors.
Hey, Ben, I think we can all agree on one thing. Like you, it's been one heck of a pain trade year to date so far. Ben Lader there of eToro. Thank you, sir. As always, constructive on this market. Still bullish. And right to be bullish year to date, at least, because last year was absolutely dreadful. Pushing ahead to CPI next week, let's give you a sneak peek of what you can look for in the inflation report. The estimates so far, just some numbers pouring in. We can put together a median for you. The median estimate, 0.5% month on month, so that's a pickup. You strip out energy and food, we're looking for 0.4. If you like the headline figures, Lisa, year over year, 6.2, down from 6.5. We're looking for core. Stripping out food and energy year over year, 5.5%, down from 5.7. They're the estimates, at least, so far.
Right. And this is really the question is, how big of a move could there be in markets at a time when the labor market keeps delivering such hot kinds of gains? David Fokerts-Landau over at Deutsche Bank changed his house view today. And he put out and basically said, so far the turn in risk appetite is justifiable, but it becomes more vulnerable as the year progresses because of this potential stickiness and because of the lag effects, the cumulative and lag effects of some of the rate hikes that we've seen today.
So the bears are pushing out the call. Is that right? Is it fair to say?
Yeah, although, the bears are getting more nuanced in terms of how much downside there is as well. Well, I mean, okay, you're laughing because you're saying, okay, they're just wrong. Perhaps, but the facts have changed.
No, I'm not
and
saying.
Going forward,
Don't put words in my mouth.
Okay, carry on.
This is it. I've had it.
Okay, this is an idiosyncratic domestic.
I'm going to go have a cigar. Leave me alone.
How's everything going, Tom?
Hey, Binky Jada's on board with this over at Deutsche Bank. That was Binky's point coming into the year. He believed you'd have to push out the recession call, and TK, ultimately, because of that, this rally has legs.
And it's a great Deutsche Bank call by Matt Lazzetti here. They started with a pushed-out recession call, unlike the gloom crew. I have trouble with a recession call when I see corporations adapting. The Frito-Lay company is adapting. The joke is it's still called Pepsi. They're really in the business of bags of potato chips and IFI. What was the first what was the first Lay's potato chip?
Lay's potato.
Was that in America?
I don't eat potato
You've
chips.
never had a Lay's
I'm not a potato chip kind of guy.
Obviously never taken a road trip.
In the UK, we call them crisps. They are
what is
crisps.
That's ridiculous.
Chris, we're going to come back after
a bag of Lays in the back
chips
seat.
are something else. No, guys.
From upstairs.
No, guys. They are crisps. Chips are what you guys might call French fries, but we call French fries, that's a skinnier chip. So chips are like a fat potato. Nice.
Yeah, I'm skinny because I had too many chips.
Too many chips?
And I'm skinny. That's how
You're skinny? Okay.
Right.
I'm not going there. I'm not going there.
Pepsi kills it.
Got to do Disney in a moment, Tom. Get ready for that. Some big cuts coming there. David Leibovitz of JP Morgan coming up a little bit later. Looking forward to that. Futures up 0.9%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, it's day 2 of Volodymyr Zelensky's surprise tour of Western Europe. The Ukrainian president is in Brussels today after stops in London and Paris. He's been thanking allies for their support and urging them to provide more weapons for the fight against Russia. The death toll has now gone over 16,000 from the earthquakes that struck Turkey and Syria. Rescue crews were still finding survivors more than 3 days after the quakes hit. Meanwhile, the U.S. has deployed an aircraft carrier to the region to provide assistance. Credit Suisse warns it faces a substantial loss this year after clients withdrew a record $120 billion in funds in the fourth quarter. Confidence has been deteriorating in the Swiss bank, which posted a 5th straight quarterly loss. Credit Suisse says that was driven by the losses at both the wealth division and the investment bank. Disney CEO Bob Iger plans to cut 7,000 jobs as part of a dramatic restructuring of the world's largest entertainment company. Disney is seeking $5.5 billion in cost savings, with more than half of that coming from its budget for movies and TV. Iger is also reorganizing the company into 3 divisions. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
results are unacceptable, obviously, and that's why we created a new strategy, transformation program. The strategy, in quotation marks, is pretty simple. It needs to be in line with the results, more or less. And I think that's the current thinking and the future thinking. I think the new culture when it comes to compensation, in principle, going forward will be, you make profit, you pay bonus.
What a difficult time for the Credit Suisse CEO. Catching up with Francine Lacqua a little bit earlier on this morning. We'll catch up with Francine in a moment. Check out the stock. It's down hard. It's negative by 8.7%. The broader market's still doing okay. Equity futures look a little something like this, up 0.8% after a chorus of Fed officials say the same thing.
What they all say.
More hikes
are
coming.
A surveillance nap.
Various versions of that,
thing.
Tom.
Yeah.
Lisa?
I mean, basically, we were looking for any dissent. There is none. They're all saying the same thing, and that is what we heard.
I think Mike McKee said yesterday they should just come out one by one and just say what he said and point to Chairman Powell.
That's essentially what they're doing.
Kind of where they're at right now.
I mean, you have an adult, acclaimed economist, Catherine Mann, in England, and her opinion is measured and it matters. Does a given regional bank president of the Fed, does their opinion matter?
I think Fed presidents can go rogue. I think at this point they just want to communicate that we've still got work to do, and seemingly they're all saying the same thing. I want to touch base with just the FX market briefly. For those of you who were waiting for that German CPI report, it came in a little bit earlier at 9.2%. We were looking for 10. Came in at 9.2, down from 9.6. So that's just something to consider, Tom.
Noisy.
Super noisy.
It was like super.
There's been some changes to how they work these things out, and we've got to work it out in the next couple of months.
No one has worked the Credit Suisse story harder than Francine Lacqua. She's spoken to 14 CEOs of Credit Suisse, the beleaguered Swiss bank, in Zurich, and she is once and again in Zurich. Francine, I got 14 questions, but let me start with assets under management. I give Credit Suisse great credibility. They did really nice PowerPoints in English. I understand it. And the basic idea here is assets under management, their savior, are cratering. Is there any reporting that they've staunched the exit of assets?
Not really, Tom, and you've 100% hit the nail on the head. The concern is not really strategy. If you look at the chief executive, we did have a conversation this morning. Look, he's pretty much delivering on what he said. He's managed to get Michael Klein his investment boutique that will become Credit Suisse First Boston in the coming months. They will report separately. What we also know is that they managed to sell the SDG to Apollo. What he has not managed to do, which the chairman had promised that they were going to do, is stem the outflows. I mean, if you look at the numbers, Tom, they're absolutely horrific. They're like $120 billion.
Right.
And when you ask, actually, what will they do about this? They say, look, there's an outreach program. Do you put your money back in Credit Suisse because there's an outreach problem? I don't know the answer to that, but investors don't seem to believe it right now.
The ballet to me, and this goes back over the years you've covered the bank, Francine, is the foreign money coming in that maybe wants an ever larger part of a venerable Swiss institution versus the Swiss people and the Swiss government. Is there any backstory here that the government's involved to slow down the pace of acquisition by Qatar and by Saudi Arabia?
So what you're talking about, Tom, is the investment bank arm, which we are expecting some kind of other anchor investor. And there are a number of rumors. It could be a big sovereign wealth fund. It could also be private individuals in the Gulf. We've also heard that it could be buying up a boutique that was of the former Barclays chief executive in the past. What the Swiss, regulators now don't want to do is for anything to get messy. But again, the model of Credit Suisse is very simple. You focus on wealth management, something that UBS is doing a lot better at the moment. But if you don't get clients to be able to stick with you, you just have a problem. So look, the regulators probably could have done a better job. This also stems from last October. Do you remember when there was a meltdown with Credit Suisse shares because of the social media storm? And at the time, they were not really ready to put that to rest, or they weren't, ready with issuing a message of support. The Swiss establishment is kind of looking at UBS, at Credit Suisse, and I'm sure like investors wondering who will at the end of the day do much better.
Francine, there's a question of how they're trying to lure some of these assets back, some of their clients back. And in your interview with Credit Suisse CEO Ulrich Körner, you asked him about this, and he said that they're reaching out to a lot of clients and that management is, quote, hopeful that we bring a fair part of the outflow back in 2023 and the rest will come later. Hope is not a strategy. What else are they doing other than please come back?
Yeah, hope is not a strategy. And actually, I couldn't really get much details on what this outreach program is. Does it mean that you call the clients? And let me remind you, Lisa, that they haven't actually lost that many clients. So they said it's about 2% of clients, but that could be because they're tied up in longer term investment strategy or money lending. What they need to do is probably call some of their big fund clients and say, stick with us, we'll give you something back. This only happens when things get better, when the headline setting getting better, and this could take a lot more time. Now, what I really press the chief executive on is when he's expecting profitability, but reliable profitability. So when they stop making these massive losses and start getting on a better foot. He said, look, let's write off 2023. It will be tough. He's hoping for 2024, but until the headlines get better, I don't know why clients would actually put more money in unless they get offered something in return.
Francine, fantastic job this morning. Looking forward to your coverage through 2023. Francine Lackwood there in Zurich. It is only February, and they're writing off the year and looking ahead to 24. That stock is down by 9.5%. If you want a stock that's higher in the pre-market, check out Disney. The Walt Disney Company rallying higher by 6.4%. Bob Iger back in a hot seat. Tom, 7,000 job cuts, $5.5 billion in cost savings.
Yeah.
Coming to a theme park near you, apparently.
Action plan, and at the theme park at Disneyland right now is Mr. Peltz. I think he's going around on the teacups as well. What's also interesting here, there's a little humor there this morning, folks.
That worked.
Right? You ever done the teacups, John?
I have when I was a kid,
like,
yeah.
Really?
When you were the little kids and you're in Anaheim. Anaheim's way better than Orlando.
I don't understand why people want to just
The Ferro family, the Ferro clan, once went
me?
to Disneyland Paris many, many years ago. In fact, decades ago. Didn't work out. Didn't work out
for me either.
There's only one. I'm sorry. Anaheim is small.
That's the one.
It's the original one.
And you love it.
And well, it was like a long time ago, but it's just magical with the right kid. The whole racket, the whole shtick really works. My point is, a guy out on Twitter, thank you so much for informing me.
Just the right kid, by the way.
You look at the amount of money.
That.
You look
if you take the right kid.
Sorry, carry on.
Please, we all heard that. What do you want to tell us? Do you want to tell us which child you'd prefer to take to Disney?
Well, no, some of them, you know.
I was going to let that go. You're brutal.
Yeah, I really don't want to be here.
Are you saying that one child had a better experience than the other?
One did Mickey Mouse, Minnie Mouse, hook, line, and sinker.
Sure.
Can I continue?
Please do. Yeah.
I looked at the subscription that Netflix takes versus Disney, which is much, much, much smaller. And so he's building subscribers, but they're sort of giving it away to catch up with Netflix?
To me, the clarity of his strategy was really what stands out. Because yes, you've got job cuts, but you also have this 3 different portfolios in the company. The idea that the entertainment part, the streaming business is put to one side. You have ESPN and sports on another. And then you have the theme park and the cruise ships and all of that on the other. That you can wrap your head around. And then you can understand each strategy rather than this morass of we don't know what.
It's a big change. Show me the money, show me the profits. No longer about show me the subscribers in the streaming business. 2 years ago, that's all it was about. It's a big change, and I think to some degree, I don't want to say all roads lead to higher interest rates, but I do think there's a change that relates to that, Tom.
EBITDA margin pre-pandemic, 23 cents in the dollar. Right now, they're modeling out 16, 17, 18 cents in the dollar.
To build on what you're saying, though, John, this idea of the cost of content, just being able to throw free money, that's over. All of a sudden, he's saying content's become extraordinarily expensive. We need to justify it more, and that does speak to your point about higher rates and the cost of money.
No.
You pumped for Mandalorian?
No.
He's not the right kid.
It's okay.
I'm not the right kid.
For Mandalorian.
Would Lisa be the right kid to go to
Andor was
the theme park with you?
He's on set with 2 people.
Were they
not
Wednesday?
The right
they weren't Wednesday.
You're not the right
Wednesday.
kids. You just
I'm
don't love
like Wednesday.
You just don't love us, do you, Tom? There's no love here. Equities rallying this morning. Good morning to you. Up 0.75% on the S&P 500. This is Bloomberg Surveillance, live from New York, with equities up on the Nasdaq by more than 1 full percentage point. We'll talk about some single names in just a moment. I want to talk about the bond market briefly. Your 2-year yield, your 10-year looks like this. In a basis point, let's call it a basis point lower on a 2-year, 441.27. On a 10-year, 359.18, down about 2 basis points. That's the bond market after all the Fed speak. 4 Fed officials with just one message. It was Waller, Cook, Williams, Kashkari, all with the same thing to say. New York Fed President John Williams said this: looser financial conditions or more supportive financial conditions might imply a higher interest rate to make sure that we're getting to the goals that we're trying to achieve. And ultimately, Tom, the goal is to get interest rates even higher. And every single one of them essentially said the same thing.
Can I mention, I'm really glad you did the bond market there, but it's also the relative yields. I look more at actual yield and the total return losses that were taken. But, John, I'm going to cut to the chase. You got a 2-10 spread, rounded down to negative 83 basis points. The low was December 7th, negative 84.3 basis points. We're getting to new, stronger, deeper curve inversion, which is part of this Fed discussion.
This is the Priam's recall, right? On curve inversion. I think she had 3 calls. Her first call was we're going to go through 5% on Fed funds. Second call was curve inversion through the whole of 2023. And ultimately, Tom, still looking for a recession in the second half of this year. Now, a lot of people might be thinking right now, well, what recession? President Biden was speaking just yesterday, Tom, who said he thinks, and who am I to throw cold water over this based on the data so far, but he thinks no recession this year, and Lisa, maybe even no recession next year.
And there are a lot of people who don't see a recession this year as well, but see it pushed out to 2024. The real question that I keep hearing in a lot of the notes that I'm reading is, can we really get behind immaculate disinflation? And one person after another says no. The Fed has to eventually kill the momentum, which by definition will create some sort of negativity later on.
I've never said this in my life. The curve inversion right now is center tendency back to the early summer of 2021. We're right on the trend of greater inversion here at negative 82 basis points. And what's concerning to me is one standard deviation, which is not a big move, is negative 100 basis points. I've never said that. I mean, that's how this trend has a weight to it.
To make it much more simple, I always say it like this. If you're willing to accept a yield that is 82% lower on a maturity that is 8 years longer,
nicely explained,
then I think you're sending a message, aren't you? There's a reason you're willing to do that.
Which really speaks to this question of, okay, the Fed has to raise rates in order to torpedo that growth, in order to torpedo the inflation for later on that will make a 3.6% yield on a 10-year Treasury worth something.
That's ultimately what's in the call. That's the call that's implied by the market pricing, Tom, and has been for the last number of months.
We will watch this thing comes up to February 14th, which I believe is an important inflation report. One of our most popular guests, everyone leans forward for Ian Shepherdson, chief economist, Pantheon Macro. Ian, you brave to go where no one goes, which is to actually study inventory dynamics. I would suggest it's the most ignored part of a GDP calculation. What do you see in the inventory dynamics right now?
No, I see a downshift, a big downshift, and hence quite a good probability of a shockingly low negative GDP number for the first quarter and probably for the second quarter as well. So quite a sharp reversal at the headline level from what we saw at the end of last year when the economy grew by nearly 3%. But half of that growth was craziness in the inventory data, which is not sustainable and actually will reverse. So in terms of appearances, markets are going to really struggle over the next couple of months. You know, we just had a huge payroll print. We're probably going to get some big numbers, partly because of the warm weather in January for retail sales, home sales, construction, all the rest of it. But I also think we're shaping up for a negative Q1 GDP number. So this is going to be very hard to read and very confusing.
Does a negative Q1 GDP mean an NBER recession?
No, I don't think it does at all. So the NBER defines recession in much more broad terms. It's all about falling output, falling incomes, falling employment. I don't think we're going to get that. The market shorthand for recession, of course, is 2 quarters of falling GDP. And I think there's a very good chance that we get that. But my guess is that the US is quite well placed to skirt a formal NBER recession. I do think that the state of the private sector's finances offer quite a big cushion against what the Fed is doing. So the Fed is hammering away with rates, but the private sector's debt service costs are still very low. Their balance sheets are pretty strong. Savings buildup is still there, for some people anyway. And so there's quite a lot of protection against what the Fed's doing. And I think that pushback means that we can probably skirt around a recession. If we have one, I don't think it'll be very bad, and I don't think it'll be very long. But my base case is we dodge it altogether.
What does that mean in terms of how quickly inflation will disinflate?
So this is the gazillion-dollar question. Can we get the sustained disinflation that we need without a recession? And I think there's some very encouraging signs there. So in particular, the downshift in wage growth over the last year and a half, since that crazy peak in the summer of 21 when it was over 6%, very scary. Fed was very worried about a wage price spiral at that point. But, Vice Chair Brainard said a couple of weeks ago she doesn't see a wage price spiral. And the ECI data last week, I think, pretty much confirmed that story. Wage growth now is hovering just around 4, which is still on the high side, but it's coming down without unemployment going up because participation is gradually creeping higher. The labour market is normalising. And if we can see in the next couple of quarters that wage growth gets down a little bit below 4, then we're back into a sustainable place without having to break the economy to get there. But this is still kind of speculative to some extent. The trend is in the right direction, but we haven't quite got to the destination that we need to be at just yet.
This sounds great, and a lot of people buy into it, and a lot of people have bought risk assets in the heels of just this call. And then used car prices went up. And I point to this very small sector because it highlights the goods disinflation that is not linear. This idea that because of the lag effects, perhaps some of the supply that was not out there during the years of the pandemic, there isn't the same number of vehicles to get resold, and suddenly those base effects are no longer beneficial to the disinflationary narrative. How important is it to watch the reinflation of certain goods sectors that really were the basis of this trend altogether?
Yeah, so falling goods inflation has been a big driver of the improvement that we've seen, and car prices have been quite a big part of that. We saw an enormous jump in new vehicle sales in January. They were up nearly 18% in 1 month. And I think that's probably an indication that we saw a strong number for used vehicle sales as well. We don't have that data yet. And that's probably what pulled prices up, because I don't think any dealers were expecting to see sales rise by 18%. So I think they got short of inventory. They had to go to the auctions to find inventory, and so prices spiked. I'm really hopeful that this is a one-time thing, but it is going to hit the CPI, and we know we're going to get some lumpy numbers. And for those people at the Fed and in markets who will want to seize on those numbers, yeah, the next couple of months could be quite tricky. But I do think that ultimately margin compression for car dealers is going to pull those prices down quite a long way. But not every month. It just doesn't work like that.
Ian, I want you to take your wonderful pantheon ability in Asia and a reopening of China. I want you to drag it over to an estimate of the resilience of the American economy. The bears are in retreat right now. Equities up today. Pepsi-Cola with bang-up earnings, et cetera, et cetera. Do you have a glass half full on the American economic experiment? And is it because of the China reopening?
The China reopening is helpful for sure. I mean, it's especially going to be helpful for US manufacturing, because essentially what happens in Chinese manufacturing today has a meaningful impact on what happens on US manufacturing 2 to 3 months down the line. There's a pretty clear line between the two. So we're feeling quite excited now about China for the spring. You know, the COVID wave was less disruptive than we feared it would be, and the rebound in some of the surveys is pretty strong already. That is going to transmit through to those US numbers. So what looks right now like a pretty nasty squeeze on US manufacturing probably is going to be easing somewhat by the spring. So we're very happy to see it. But of course, you know, manufacturing is only, 9% of payrolls and 11% of GDP. It's not a game changer, but it's certainly helpful at the margin. And it is part of the story why we don't have in our base case forecast a US recession. Now, had China stayed in the hole, you know, that would have been more of a problem. So at the margin, it's helpful. Of course, at the moment, Chinese inflation, PPI inflation, is still negative. It's like almost minus 3%. And a year and a half ago, it was plus 11. So that's helpful as well, because that's working through gradually into disinflation pressure in the US, coupled with the domestic margin compression that we're seeing in retail. So those two things together, it's quite a nice story. You know, still got falling prices in China, but we've got stronger growth as well. So it's the right combination, and we hope it persists. It's kind of our base case that we're going to keep that for a while.
Let's get to the important question, Ian. Should Man City get relegated?
Well, if they cheated, they should, absolutely.
There we go. It's very diplomatic.
I don't know whether they did or not, but it doesn't look good, does it?
I know, seriously. I think he was thinking about Newcastle's
own He decided that the answer to that question 5 days ago.
Well, it would put us up one place. It would put us more firmly in the Champions League Champions League positions were something unpleasant to happen to them. So, yeah. I wouldn't mind.
There we go. Ian, we got there. Ian Shepherdson of Pantheon Macroeconomics. Ian, thank you, as always. What are you up to?
Here, have a Walker's Crisp. It's a Walker's Crisp.
I will not eat crisps.
Brammo grew up on these.
I refuse to.
I didn't know
I won't eat crisps.
A Walker's
I certainly won't eat crisps at 6:40 in the morning.
Really?
Yeah. No one wants to hear that. Nobody wants to hear that.
How about the crackling of
Did you say the organic revenue growth?
Just hearing that, it's just like,
14% organic revenue growth. Frito-Lay was 18%. Granted, now, to be honest, Pepsi, their view forward is
this how we're going to do?
depressed.
This is how we're going to do
earnings
for PepsiCo and other companies as well.
Yeah, I think that
I hope this is where it ends. When we first started doing the show together on radio, and it was just on radio, I'd go into the studio at about 7 a.m. we'd go live. So I'd be there at about 6:45. I'd get there early. He would turn up. He would turn up at 7:05, so 5 minutes into the A block, and he'd be eating his breakfast, and he'd start trying to speak whilst he was eating his breakfast.
What was he eating?
I've no idea. It would drive me absolutely insane.
It's in my agreement. Yeah.
Insane. That's in your agreement?
Yeah, Eggs Benedict. Thursdays.
Eggs Benedict on a Thursday.
Had to go away because, we don't have the room here to
we cut costs.
Yeah.
Yeah.
So now it's just eggs.
They wanted me to go to egg whites, and I just said, no, I'm not going to do that.
Are you done now? You're done messing around?
I just, we're taking, seriously, folks, we're taking real pride here. I can speak for the network, but also for us. Earnings is more than just Apple and Alphabet. And Pepsi matters. I'm sorry.
Well, and this is the interesting thing about Pepsi. They did blow the estimates out of the water for the fourth quarter. But what they see going forward appears to me like margin compression. This really speaks to this, gravitational force of trying to cater to consumers that have greater discretionary power.
You're the worst. Honestly, you are the worst.
This is going to be a real domestic.
Can you imagine?
Idiosyncratic eating.
The crunching thing just drives me nuts.
It's ASMR. That's like there's a whole industry around it for kids these days.
For very bright kids, I'm told.
Oh, really?
Yeah.
What is
high IQ.
Yeah.
Because you're having high-level thoughts.
What is ASMR?
And then someone starts crunching.
Yeah.
I'm having high-level thoughts.
It's a crisp.
You're not the right kid for it.
Futures up 0.75% on the S&P. This is Bloomberg.
The things we learn about Tom Keene. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, rescue crews, they continue to pull survivors from under the rubble of collapsed buildings in Turkey. But hopes are starting to fade more than 3 days after 2 massive earthquakes killed over 16,000 people in the country and Syria. The U.S. has positioned an aircraft carrier in the area for assistance. The Biden administration still resisting calls to provide fighter jets to Ukraine. But Secretary of State Antony Blinken won't permanently rule it out. He says as needs have evolved, the U.S. has adjusted in what it's sent to the Ukrainians. The administration has seen sending fighter jets as too provocative of a move. Officials at the Federal Reserve are keeping up for those hawkish calls for further interest rate hikes. 4 policymakers speaking at separate events on Wednesday delivered a similar message. They welcome a recent moderation in inflation while warning that the fight is not over yet. First Abu Dhabi Bank is pressing ahead with a potential offer for Standard Chartered. Bloomberg has learned that a bid is possible once a cooling off period required by the UK takeover rules lapses. Now, First Abu Dhabi is exploring an all-cash bid in the range of $30 billion to $35 billion. And in pro basketball, a mega deal involving the Brooklyn Nets and the Phoenix Suns. There are multiple reports that the Nets have agreed to trade superstar Kevin Durant and T.J. Warren to the Suns in exchange for 3 players and a series of first-round draft picks. Now that completes Brooklyn's dismantling of the team that once included Durant, James Harden, and Kyrie Irving. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I'm not sure content's king anymore. There's a lot of average content that's sticky. Why content's no longer king is there's too much content, Lisa. There's too many platforms. And at some point, you need to ratchet that back. Maybe content will be king in the future. Right now, it's platform.
Michael Nathanson there, always fantastic to catch up with the man at SVB Moffett Nathanson. Equity futures right now, positive 0.75%. Disney shares absolutely flying. The stock is up by more than 6 percentage points, positive 6.4%, after the company announced a dramatic restructuring plan, including 7,000 job cuts, $5.5 billion in cost savings, and the returning CEO, Bob Iger, saying this: we're going to take a really hard look at the cost for everything that we make, both across television and film, because things in a very competitive world have just simply gotten more expensive, and that's something that is already underway here. Tom, that a message, of course, as you know, for Mr. Pounce as much as anyone else.
Yeah, really, really important, and maybe it's a new Bob Iger, and we'll have to see on it. What I would suggest, folks, and I think this is so important, is maybe Disney is the one blue chip stock where people have been most rattled. If you look at Disney, the great blue chip from 2008-ish out to 2021, where we woke up on the non-profitability of streaming, John, 15.7% per year. And that was the Iger triumph.
Do you remember we used to talk about it being perfectly barbelled to stay at home and reopening?
Yeah.
They were like the good days: subscriber growth, stay at home, streaming. Tom, it's changed and changed quickly.
It's changed hugely. And of course, this with the Mandalorian rollout coming up here in a bit. I just say that, folks, so we can run on. For those of you on radio, we'll run the Mandalorian video.
I'm very excited about that. Do you want to explain what it is?
It's like a Star Wars spinoff, and I'm really not excited about it. I watch it
you just
sort
keep
of
talking
just to
about
see how it's manufactured.
Okay.
But I'm not in love with it. Like Queen's Gambit, I thought was phenomenal.
That's fantastic.
The chess thing.
The book was
haven't
fantastic.
seen that yet.
I haven't seen it.
But you haven't seen Queen's Gambit?
No, not yet, no.
There's one on radio right now. We're looking at Mandalorian, which is the hope and prayer for Mr. Iger forward. To give us a brief on this, Geetha Ranganathan joins us, U.S. media analyst at Bloomberg Intelligence, and she knows to the penny the score. It's real simple, Geetha. Netflix on top. They bring in $11, whatever, per subscriber, and Iger can't get out of his way. He's bringing in $4, even $3 and change per subscriber. Can that model continue to work, or does Disney have to raise prices and get serious to compete with Netflix?
So Disney actually did just raise prices. Disney Plus did raise prices by about 38% just in December. So we didn't really get to see the whole impact of that in this quarter that they just reported. But I think it will. We will get to see that through this year. As you pointed out, there's a huge delta there between that ARPU for Disney Plus and Netflix, and they kind of did that intentionally when they were in that subscriber land grab phase. But of course, now we're going into a whole new phase, and they have to be able to accelerate their revenue growth. That was one of the things I thought that was really kind of missing in the Disney presentation, because while we saw so much on the cost front, we didn't necessarily see them articulate a strategy to accelerate revenue growth. And that's exactly the point that you bring up, and they have to do that.
Well, let's start on costs, and then we can get to revenue growth. Let's talk about costs. $5.5 billion of savings, 7,000 jobs to go. Where are those cuts going to go, Geetha? Where do they come from?
Yeah, so what they're talking about, the $5.5 billion, they have to divide it between content costs and non-content costs. So right now, Disney is spending about $30 billion, just upwards of about $30 billion every year on content. Of that, about 10 to 11 billion is on sports rights. So there's really not a whole lot of flexibility there. But on the remaining 20 billion, that's where they're looking to cut about 3 billion. So about 15% of those content costs are what they're looking to trim. So it's really more in the general entertainment kind of division. You also have about 2.5 billion of non-content costs. And that's where we're kind of going to see the workforce reduction. And a huge chunk of that is really going to be on marketing spend. So, they've already kind of abandoned their subscriber targets for Disney, so they're really not going to go out very aggressively in terms of marketing, in terms of product launches. So that's where we're really going to see a lot of the trimming of the expenses.
Where are they going to grow their profitability, Geetha?
So that is really the question. So the profitability right now, the way that they're kind of approaching the equation and the math here is they're really looking to take out costs. But I think eventually, as we go back to that point, they're going to have to somehow accelerate revenue. Yes, I think eventually what's going to happen, and we saw that just with the rejiggering of the organization or the unwinding of what Bob Chapek had done, just by kind of splitting it now to 3 segments. So you have entertainment, you have ESPN and parks. Parks, of course, is firing on all cylinders. But with the entertainment, I think ultimately we're kind of going to see all the linear networks fold into the streaming business, and that kind of will eventually, I hope, give them much more pricing power. So kind of closing in that gap between that $4 and $11 on the streaming side.
What did you make, Geetha, of the comments about how in the old regime they talked about spinning off ESPN and selling it, and they decided not to? What was your takeaway in terms of the potential profitability of that unit?
So this has kind of been this age-old question for Disney, right? They're caught between a rock and a hard place here. So ESPN is a huge cost center. So that we already talked about $10 to $11 billion in sports rights, but it's also a huge profit center for them. It brings in about $3.5 billion in EBITDA. That's no chump change for a business that is losing about $4 billion on the streaming side, right? So they absolutely need to have it, but it's also this very tricky balancing act between linear TV and streaming, because if you really look at it, I think the future of the entire TV bundle for the whole media ecosystem hinges on what Bob Iger does with ESPN. And so he has to play his cards very, very carefully. By kind of separating it out, I think it kind of gives them a path in the future to maybe spin it out, but they still want to extract whatever they can from it right now.
Geetha, the three of us did a retreat last weekend with McKinsey. And, we want to be cutting edge here, and like Disney Plus and Paramount Plus and Discovery Plus down in flames. We're thinking surveillance plus. I mean, we're looking at surveillance plus, and we're just saying, this has got to work. When does all this stupidity end and they realize the customer's in charge? That's what Discovery learned yesterday, right?
The customer has actually pretty much been in charge, I would argue, because, with all of these streaming platforms, I think the customer has really won with kind of the amount of choice. And you're absolutely right with Discovery. Again, it's kind of coming down to, they just didn't see that much of overlap between the Discovery Plus and HBO, and they want to be able to retain the 20 million subscriber base that they have. Yes, Shark Week is huge for them.
I love it. Please, don't make fun of Shark Week. Come on, Geetha.
I love it too.
Where is this going?
But we are in this phase of rationalization, Tom, and you talk about the stupidity, and now there is this sense of austerity. There is this sense of rationalization, and we're very much in the shakeout, the streaming shakeout that we've spoken about is well underway.
To have Michael Nathanson and Geetha Ranganathan with us. I mean, John, this industry for Americans, where Hollywood was this magical thing on Sunday evening, the culture of it, it's in total chaos with that announcement yesterday.
Geetha said
Discovery.
The customer had won. And I think maybe that was true a couple of years ago. I don't feel that way anymore, Geetha. In fact, I feel like I'm losing. I feel like the credit card company's winning because of all the fees they're getting at the moment from the amount of streaming apps I've got. But do you really think the customer's still winning?
I think the customer definitely has power. I mean, I think that's kind of what streaming has been all about, right? Giving the customer power, just the ease of cancellation, signing up, signing off from a service. So there's definitely a lot of choice. And now I think it really comes down. I mean, I really like Michael Nathanson's point about content not being king, but platform being king. And so now it's really about, these platforms kind of making it more and more user-friendly, kind of making discoverability so much more easier. And I think in that, first it was just having so much content. Now it's having better and better features, more bells and whistles.
Geetha, can you and Paul Sweeney, by Friday night, figure out English football Saturday morning?
Exactly.
Because John and I can't find
that
anything.
line there. That word's perfect. Discoverability.
I can't find it.
The amount of friction in the user experience now to get out of one app, get in the other app. You're living this now too. Saturday mornings.
Surveillance Plus includes Saturday morning guide with Tom and John
It should
to
do.
get the different football games.
Don't knock it. People are paid for that.
Geetha gets us fired up. Geetha's
that.
got to come on more. She gets us fired up. This is serious stuff.
Geetha Ranganathan there of Bloomberg Intelligence. Geetha, as always, thank you. TK, it's just got to that point, hasn't it, where it's ridiculous. I mean, can they do something with Hulu? I wanted to watch a documentary on Disney Plus yesterday evening, and I went on Hulu to see if I could find it, because it's meant to be there.
Right.
Some of it is, anyway.
Oh, John,
to drop out of Hulu.
The Tom Keene story, you were going to watch it?
Disney Plus. I wanted to watch the Tom Keene story.
That's what I thought.
And it wasn't available.
Michael Barr,
also
Bloomberg Business of Sports.
Drives me nuts.
They put NFL football on Amazon, and the ratings went down.
Shock.
And Michael Barr said, people can't, the old folks
I don't know where it is anymore.
They can't find it.
What about the search function? Unlike Roku, you guys can't do that?
I don't have Roku.
Oh.
What'd you do? Speak to the remote control?
I don't know.
I shake it.
Where is
dance. Come on, just tell me.
Honestly.
No, you can do a search function.
Saturday mornings I'm there like at Hulu, and then I'm just like Peacock, and then onto Paramount.
And then you throw
And
the
then,
remote.
like,
We came
come
so
on.
close to having the Tom Keene story on Netflix.
We'll make that
so
happen,
close.
Tom. We'll make that happen.
Sold
The good
price.
times are over. It's in yields.
I think it's very tough to take what Powell said and to say risk on.
There's a huge amount of uncertainty out there.
I don't know that inflation is a one-way trip up and a one-way trip down.
It does look like maybe some of the biggest, most aggressive inflation on the good side has come off, but we still have this services inflation.
People have either put themselves in the transitory camp or the non-transitory camp, and the reality is we have some of both.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Can we just pause for how beautiful New York City looks this morning? Just absolutely stunning. Good morning to you, Tom. Emotional, sensitive,
It's like an early
always
spring,
is.
and
Lovely.
to be clear, we've had a non-winter. We had a little bit
We
of
did have.
snow, but
We had a-
for those
we had a
of you
week of winter.
worldwide, it's essentially been a non-winter.
I think we're getting to about 11, 12
It's some
centigrade
cold.
today. What's that in Fahrenheit?
It's like 60. Like we're getting out on the edge of 60.
Nice.
You know,
Okay.
It's good.
Bramo's wondering what we're talking about, so let's move on. Equity futures positive 0.75 to 1%
Not the only one.
on the S&P. You think other people don't
on,
understand
John.
the emotion,
People
the
understand
beauty of New York City
it's
as it starts to
fantastic.
get warmer?
It's fantastic to watch it on a screen from afar because we can't actually see it. But I will tell you this: it is beautiful. I love it when the sun comes up, but it's uncomfortable that it's been so warm. I don't. I like. It's been like,
It's
where's my
uncomfortable.
winter?
You heard this? This is how bears feel.
Oh God. S&P 4,200. We beckon S&P 4,200.
Possibly, yeah.
Nasdaq up a stick this morning. Are we thinking 13,000 Nasdaq? I mean, is this a bull market? Ben Laidler was talking about that earlier.
I'm thinking February 14th might have something to say about that. That's the next big
little
stop
bit
for
to
this
say
market.
about it.
Never mind the Fed speak,
No
Lisa.
question.
It's all about CPI next week.
If we get a hotter print, how much does that really take some of the momentum out? Versus how much do we see a rally kind of reassert itself? And this perhaps is the case that people aren't talking enough about. If the CPI comes in softer, if we get this feeling of disinflation and people buy back into the disinflationary, the immaculate disinflation story that seems to take hold in January.
Jobless claims a little bit later, 8:30 Eastern time. We're looking for 190,000, up from what, 183 previously?
Yeah, whoa.
It's just
Climbing.
stunning. So
Soaring.
compare and contrast that data point to what we're hearing from companies. So Walt Disney, the Walt Disney Company, the latest to say 7,000 job cuts. I think Affirm, do you remember buy now, pay later?
Yeah.
Big boom last couple of years, 19% of the workforce said to go. I think part of the JP Morgan business around mortgages, some cuts there as well. So we're seeing these cuts come to the surface, just not seeing it in the labour market data.
Well, we see the cuts there, and then you have the likes of Pepsi coming out better than expected. You see Hilton just coming out, reporting earnings that beat estimates, this idea of travel, and you can't fire what you can't hire, right? And you've been saying that a lot, John. So you have the service sector that wasn't able to add the employees during the pandemic quickly enough that now are restaffing and bringing people back on. So again, how much do the headline layoffs really reflect true softening in a labor market?
Corporate discipline's back. Can I say the quote of the week goes to Satya Nadella of Microsoft in the Financial Times? Did you see this quote?
Which one?
I haven't heard a tech company, a big tech firm say, you know what, your margin's my opportunity for a long time. And he name-checked Google by name and said the following: from now on, the gross margin of search is going to drop forever. He went on to say this: there is such margin in search, which for us is incremental. For Google, it's not. They have to defend it all. Like, that's pretty punchy stuff.
Well, at a time when, and I'm sorry to keep mentioning ChatGPT, but artificial intelligence is changing the game for search, which is the reason why Google shares torpedoed yesterday, because their attempt at ChatGPT wasn't as successful as people thought. But this really is going to squeeze the margins because you can take out a lot of the people that are behind it.
You're telling me Bing is going to take over search?
Do you Bing a lot?
Do you Bing?
No, I looked at it 14 years ago and said, "Are you kidding me?" and moved on.
Lisa and I talked about this yesterday. You probably didn't hear us, did
Probably
you?
didn't hear it.
No, good.
Oh, my goodness.
Chips.
Oh,
I love it when you do that. It's great.
Thank you.
Tom. I think the analyst community are slightly pushing back to Tom's point that maybe we're taking this too far. It's very early days, but I think it is notable to hear Satya Nadella of Microsoft just say, you know what, we want some of that.
We want some of your business. And you know what? We have the infrastructure and the programmers to make it happen, which highlights, first of all, how transformative some of this technology really is. And second of all, why good artificial intelligence programmers are in massive demand regardless of the labor market.
Equities right now up 0.75% on the S&P 500. Lisa will run you through the day ahead in just a moment. Yields coming in a couple of basis points. A 10-year, Lisa, just sub 360, 358.80 on a 10-year yield.
And we'll get some more sense of whether we go further or lower in terms of yield, higher in terms of price on that 10-year after the incredible auction that we saw yesterday. Today, we're looking at jobless claims, 8:30 a.m. We get that latest read. If you take a look at the chart of initial jobless claims.
On radio, it's a great chart.
It basically shows how high they were in the aftermath of the immediate pandemic lockdowns, and then just how they have just compressed to some of the lowest jobless claims that we've seen on record. I did strip out the pandemic, though, John, because I know it's a chart crime. So that is an issue. Okay, 1 p.m. We're waiting for the next auction. Tom, you got to pay attention to these auctions. Yesterday's 10-year auction was actually really important. Today, they're selling $21 billion of 30-year bonds. Do you get the same kind of flood of international cash coming into the U.S. market because they do see the Fed successfully bringing inflation into control?
Well, I think you're right. When he sees this coming up, I think you're way out front on this. I mean, you're the one that brought to my attention that T-bills near 5%. People like me don't know that.
And since they've actually come in a little bit, perhaps because everyone's like, wait a second, this is actually a really good deal. So perhaps that is also affecting the cost of money. And Satya Nadella's point of, just in terms of rationalizing some of the expenditures. And aftermarket, we get a bunch of different earnings, including Lyft, also Expedia, Yelp, PayPal, all of this really a question around the consumer. And John, that's what I'm looking for. Do we get a sense of how strong, how resilient the consumer is in the face of still pent up cash and a labor market that's very strong?
Uber numbers were pretty decent. Lyft right now up about 2.3%. Around the table with us here in New York, I'm pleased to say, David Leibovitz, Global Market Strategist at JP Morgan Asset Management. David, good morning to you.
Good morning.
Why shouldn't I just buy a T-bill with a yield close to 5% and call it a year and walk away?
So it's interesting because the conversations that we've been having with clients as of late are, do you take advantage of this near-term opportunity that's manifested itself in fixed income, or do you look at what's gone on in equity markets, and this was more before the rally we've seen over the past couple of weeks, begin to step in there with the idea that over the course of, say, 2 to 3 years, you'll outperform, albeit with higher volatility. We see a lot of people embracing that short-duration fixed income trade. I think to your point earlier about the rally that we're seeing and the expectations around inflation, it's going to take one bad inflation print, one unfortunate jobs print, one hawkish speech from a Fed member to I think, move risk assets in the other direction. And so from our vantage point, we want to continue to play it relatively close to the chest, hit singles and doubles, and I think short-term fixed income allows you to do that.
How much are you in cash? To me, it's really germane here going into this inflation report and in February versus the last week of December. What is the recommendation on a cash position?
So we'd be comfortable holding a little bit more cash
give me a number.
usual.
Come on.
So I think if your baseline is a 60-40 portfolio, having up to 5% in cash to us makes sense. On the one hand, cash is actually paying you something, right? To your point about T-bills, it's not like you're sitting there earning zero, which was the case for the better part of the prior expansion. At the same time, it does feel like markets are a bit ahead of themselves, and so we think that there will come an opportunity later on this year to deploy that cash at more favorable valuations.
We've got a great, out of our London desk this morning, we have a fabulous article about how trend followers are getting on the bull market trend, and a lot of other people are rationalizing this. You at JP Morgan are living this in real time. Are you people detecting a bull market trend, or is there so many secondary ideas out there you just can't get on board?
So I would say more the latter relative to the former. I think the big thing that nobody's talking about is where the VIX is. I mean, volatility's low. VIX is below 20. That brings all the systematic players, all the trend followers back into the market. You look at the backup that we've seen in rates. You look at what's gone on in equities. They're latching on to that. But my point, and I guess what gives me a little bit of pause, is the market tension that I see between equities and rates that's evolved really since Powell spoke at the January FOMC. You've seen rates move higher. You've seen equities move higher, and that move higher in equities has been led by the names that were most sensitive to rates in 2022. So, I mean, maybe help me square this circle. Maybe I'm missing something, but it feels like there's a bit of a tug of war here. I think the bond market's going to end up being right.
So what are you looking for in terms of reassessing and deploying that 5% of cash that you're holding?
So I think, again, it's really about expectations. On the one hand, on the earnings front, right, expectations are finally begin to align with reality. I think the bigger risk is around the inflation story. And, you know, what keeps me up at night, and not my kids, the other thing that keeps me up at night is, again, you talk to investors and they say, well, look, you know, we're seeing this disinflation. Inflation's beginning to come down and growth is better than expected. Well, if growth is better than expected, that means that inflation probably isn't going to come down as quickly as what everybody's thinking. And so, you know, I do wonder if 6 to 9 months from now, we're going to have put the term disinflation up on the shelf with the term transitory, and it's going to be something that generated a lot of fanfare, but really failed to allow the rubber to meet the road.
So what's going to be the other side of that, right? Is it the goods inflation that comes back? Is it services sector inflation that is more significant? Or is it really the labor market, the wage prices that are going up in a way that perhaps aren't reflected by the absolute numbers because of compositional effects?
So I think it's going to be that labor market component and the pass-through into services prices. You know, Powell has been very clear that they're going to look through what's going on in housing. They're going to focus on whether or not there's a wage price spiral taking hold. But what we're seeing from a labor market perspective is labor hoarding, right? Businesses, if they can operate with 5 people, but they currently have 7, they're not laying off those additional 2 because they're worried they're going to have to hire them back at a higher price down the road. And so I think that, again, is what's going to support inflation here going forward. I do think we could hit relatively attractive levels, something with a 3 handle by the middle of the year. I think the question is, where are we at the end of the year? And I think that inflation print probably still has a 3 handle come the end of 2023, which is something that not a lot of people are talking about.
Just listening to everything you've said in the last 6 minutes or so, all roads seem to lead to the same question. Why is tech outperforming?
So I think that there are a couple of reasons that tech's outperforming. On the one hand, I do wonder if it's a little bit of a dead cat bounce, right? It got so beaten up in 2022
CFA,
that it's finally beginning to come back into vogue here. You know, the other thing that I think you're seeing, and you guys were talking about the layoffs earlier, and I think we actually talked about this last time I was with you, tech's taking its medicine. Right, the primary lever that they have to pull to defend their margins is reducing their labor footprint by reducing their employee expense. And so I think to an extent here, the market is saying, look, you know, they're doing what they need to do to maintain profitability. Look how beaten up they got from a valuation perspective in 2022. You know, what I kind of struggle with is this idea that the Fed is closer to cutting than we think is the case. I do think that that's tangential to the broader narrative, this idea that at some point here down the road, we do end up with lower rates.
You can tell you've been doing this for a while because whenever Tom talks, you just keep going, and that's the right thing to do.
He does. It's great.
You're giving tips to people. Come on.
Just any advice for any newcomers who might want to join this program? Just keep talking.
Keep going.
David Leibovitz of JP Morgan. David, thank you, sir.
Thanks, guys.
Is this a dead cat bounce? Tesla, and this is from the team here at Bloomberg. Look at the intraday low of the year so far, okay? And then look at the move we've had since then. The low was on January 6th. We are up by 99% from the low in early January on that name. That's a monster move.
It is a monster move. Is it just sentiment, or were there some things that did change also with some of the deliveries, particularly in China?
Fascinating move. Coming up in the next hour, Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Looking forward to that a little bit later.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's day 2 of Volodymyr Zelensky's surprise tour of Western Europe. The Ukrainian president is in Brussels today after stops in London and Paris. He's been thanking allies for their support and urging them to provide more weapons for the fight against Russia. The death toll has now gone over 16,000 from the earthquakes that struck Turkey and Syria. Rescue crews were still finding survivors more than 3 days after the quakes hit. Meanwhile, the U.S. has deployed an aircraft carrier to the region to provide assistance. Credit Suisse warns it faces a substantial loss this year after clients withdrew a record $120 billion in funds in the fourth quarter. Confidence has been deteriorating in the Swiss bank, which posted a 5th straight quarterly loss. We spoke with CEO Ulrich Korner.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, to create a new Credit Suisse, much more focused, simpler, built around client needs, in the midterm very profitable.
Credit Suisse's trading revenue has plunged 96% in less than 2 years. And Disney CEO Bob Iger plans to cut 7,000 jobs as part of a dramatic restructuring of the world's largest entertainment company. Disney is seeking $5.5 billion in cost savings, with more than half of that coming from its budget for movies and TV. Iger also is reorganizing the company into 3 divisions. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The idea of shooting down a balloon that's gathering information over America that makes relations worse. Look, I made it real clear to Xi Jinping that we're going to compete fully with China, but we're not looking for conflict, and that's been the case so far.
The President of the United States, speaking to PBS yesterday evening, this is how China responded to some of those remarks made in the last couple of days in that address in the State of the Union. The quote from the Chinese Foreign Ministry spokeswoman: "The US remarks are highly irresponsible and violate basic diplomatic protocols." Tom, they went on to say, "We are firmly opposed to that and condemn that." So I guess that's them slamming the president for what they called highly irresponsible remarks about Xi.
It's one of the stories out there, and I'm going to give major credit to Elizabeth Economy, now working with the Secretary of Commerce, but with her, original work at the Council on Foreign Relations. She has led on this in 2 books for 5 years. Is the way they do federalism in China, there's at some point where he gets some real pushback, and Biden has to step lightly, given the domestic realities of China.
Does anyone in the US government believe that that was a weather balloon?
No, I don't think so. I think the reporting literally in the last 24 hours is there's many of these. We just don't see them.
Precisely. Just to put those remarks from the Chinese Foreign Ministry spokeswoman into, a better context perspective.
Nobody believes that they're weather balloons. This does raise a question about Xi Jinping's power domestically and how much he really is trying to message to people domestically, because this isn't going to necessarily resonate in the U.S. where people say, oh, maybe we shouldn't say anything.
Any number of themes here that we have this morning, and we'll get to China, of course, and the President of the United States and all that we witnessed in the last week. Anne-Marie Horton joins us now, our White House correspondent. Also, it's been far too long. Maria Tadeo joins us in a very busy Brussels this morning. Maria, John and Lisa really want to focus here on what we see domestically, but I've got to go to the headlines and the jumble of headlines and to generalize about jets over Ukraine. The idea of a visit to the United Kingdom, I wouldn't know a typhoon from a typhoon jet, but how close are we to jets being used by Ukraine in their war with Mr. Putin?
Yes, Tom. And by the way, before we get into that, the mystery has been solved, revealed. Volodymyr Zelensky is here in this building with European leaders, and the European tour, to your point, continues. He's done London, Paris, and today will be Brussels. Now, it is about the fighter jets. We know that the debate around the tanks has settled, and the Ukrainians now say we need those planes. That was a message in the UK, was a message yesterday in Paris, and that is probably going to be the message today. I would also say, if you allow me, for an international audience, the fact that he's here for Ukraine is useful because he will get FaceTime with 27 heads of states at the same time, with the top European institutions in the same place. And beyond that also is a message that he wants to carry through to the European audience. Every national TV in Europe, every newspaper tomorrow will show what's going on today in Brussels. Again, we are waiting to hear the results of the meeting, but he will respond and continue to say we need those weapons, especially, Tom, and I think we've got to pay attention to this. Ukraine is concerned not just about what may happen around the date of the 1-year mark of the invasion, but also the spring offensive. That's what they worry, a regrouping and retraining of Russian forces.
Meanwhile, Anne-Marie, there's a growing groundswell of pushback in the U.S. about how much aid to deliver to Ukraine. And we didn't necessarily see that emphasis in the State of the Union with President Biden. What's been the aftermath and what's been the response to the European push to try to support Ukraine heading into the spring?
Well, the president was pretty clear in his interview with PBS yesterday. He was asked directly about this, and he says, I have a firm commitment. And then Judy Woodruff had followed up, and he said, yeah, it will go on. It will continue to go on. It's pretty ironclad that they are going to stand there and support Ukraine. So the president, he is still keeping that line that this aid will continue. There has been pushback, of course, but also the pushback that we've seen from the likes of Speaker McCarthy, who said there won't be a blank check, is a lot of Republicans saying they want oversight on this. And some of that is starting to step up as well. But you can imagine the United States, especially yesterday, Jens Stoltenberg from NATO standing next to Secretary of State Antony Blinken talking about that they will continue this commitment to support Ukraine. The president said, speaking of the Europeans, making sure he keeps NATO united, that's something he's very proud of. The other thing to really watch was, I thought it was fascinating, Secretary of State Blinken's comments on fighter jets. This is something Ukraine is asking for, and he didn't outright say no. He left a tiny window open, saying that their response has evolved, and we've seen that response evolve, most recently with the Abram tanks.
We also heard in the PBS NewsHour interview, which you mentioned, Anne-Marie, some comments on China. And this is really where we started the conversation about the aftermath of these balloons that now we understand are in a number of different places and have been used for a while. It was interesting. President Biden was asked about whether this escalates the tensions with China, and he seemed to shoot that down. Can you give us a sense of why and whether there is any real threat from any of these surveillance balloons?
Biden doesn't think that this one incident is going to, push them off track in what they're trying to do with China. What this administration wants to do is try to have a better dialogue, but make sure that they're in constant communication. But at the same time, he said he's been clear with Xi Jinping that they will compete aggressively with China. Interesting in this PBS NewsHour, though, interview, kind of off the line that he ad-libbed at the State of the Union, saying, name me one leader that wants to trade places with Xi Jinping. He said in this interview, Xi Jinping is under enormous pressure, and he's not doing well at home domestically. And to Jonathan's point, you heard from the foreign ministry come back immediately saying this is not part of normal diplomatic procedures, and also said that the international community knows who the #1 spying nation is, pointing its finger at the United States. What Biden looked into there is something that we don't always hear in America. Americans, lawmakers, they always want to talk tough on China and Xi Jinping, but something that we talk about a lot is that at home domestically, there's been a lot of trouble for Xi Jinping, whether or not it's the debt issues, whether or not it's the housing market downturn, the fact that a number of individuals are getting COVID and their official figures are not talking about that. It's a much more inflated number when you look at the World Health Organization. These are enormous domestic concerns for Xi Jinping, and sometimes that pushes the nationalists in his party to really want to hamper down with this rhetoric on the United States.
MH, there was some outreach from the Chinese government. I have to say, going back to maybe the G20, you were there. Was it in Bali? It just seemed like a softer tone coming out of Xi Jinping. How does that fit in with what we've seen take place over the last week?
Well, they feel like their backs are against the wall, right? We still don't know whether or not this directive of this Chinese spy balloon came directly from Xi Jinping or maybe other parts of the Chinese Communist Party. So to his domestic audience, he has to make sure he is talking tough. He has to do that, especially at this time if he is struggling a little bit domestically as they try to rebuild this economy coming out of what many would call a failed COVID-0 policy. This is what Xi Jinping has to do. But obviously, and one thing Biden talked about in this interview was the fact that he said when he called Xi Jinping over the summer, he said, look at what is happening in Russia now. McDonald's, all of these companies, hundreds of companies are leaving Russia. Who do you think in the future is going to be investing in China?
MH, great point at the end there. Thank you. Anne-Marie, alongside Maria Tadeo, on the tension between those two countries, and that tension, Tom, not going anywhere anytime soon.
Yeah, I think there's two major stories here, and I do agree, and I think you and Lisa have been really good on this, that there's a horror of the war, the horror of Turkey that we're all seeing right now. But the overwhelming geo story is China, Europe, China, America, frankly, China. I mean, the struggle within China.
America, Europe, getting more interesting as well, Bramo. That's one to watch this year.
Especially with the Inflation Reduction Act and what kind of response you get from Europe.
If we do get a response
You think
from
we're not going
Germany,
to?
from France, they've got to come together and put something together.
And they
I think it's
disagree.
all well and good complaining to the United States. We don't like your Inflation Reduction Act. We don't like your subsidies. And I think the Americans just turn around and say, okay, come up with a plan.
You try to get a hotel room in Paris?
Right, that's a change of topic. Tom, how's that working out?
Topic.
You heard Paris.
Some Europe-US tension right there. One hour away from jobless claims in America, looking for something like 190,000, which historically is ridiculously low, even if it is a bounce from 183,000 in the previous week. Equities going into that up 0.75%, let's call it 0.7% higher. A bounce back in the Nasdaq, up by more than 1 full percentage point. Yesterday, difficult, just a chorus of Fed voices all saying the same thing. In the bond market, the 2-year still in and around 440 on a 2-year yield this morning. Yields are unchanged at 442.32 on a 10-year, 359.75. Yields in a single basis point. I want to talk about Europe briefly. Talk about Credit Suisse getting hammered by 7.7%, or you can go to the Eurozone and talk about euro dollar. 107.71, slightly stronger. Inflation data finally out of Germany, delayed by about a week or so, comes in at 9.2%. Now, you can focus on the change. It's lower than it was before, or you can focus on the number. 9% in Germany, Lisa, is not good news.
Especially because it was higher than what people had expected when they drafted some fictitious global CPI number for the entire Euro region. So that's going to go up. That's going to get revised higher as well.
I can't imagine what the Bundesbank handles. You know, when I started, Deutsche Bank was the number one, Deutsche Mark was the number one currency when I started studying all this. I can't frame 9%.
9%?
I just can't.
I don't think they can either. I don't think they can either, which is why, Lisa, you're going to see more and more pushback from the Bundesbank and from other parts of Europe to the ECB effort, and maybe the periphery if we do get those dovish calls to say, hey, slow down, slow down. I think they're going to say, hey, 9%, no thanks.
Yeah,
exactly.
Keep going. Although so far the peripheral region has been contained, at least spreads have been contained. So for now, the pressure really is on just doing more and trying to curtail some of the inflation.
Lagarde, we're not here to close spreads.
Yeah, and then the next day we're here to close spreads.
A few months into the job.
Yeah, and then it was literally the next day. Let's close those
Things
spreads.
change.
Yeah. So let's take a look at some of the earnings. We've been talking about Disney all morning, and I want to take a look at just how much that share price is popping after the announcement of the reorganization and the $5.5 billion of price cuts. Of cost cutting, 6.4% gain. Does this get it done? And I think that Geetha Ranganathan really highlighted the main question. There's a lot of cost cutting. Where is the revenue growth going to come from? We know that the parks business is a cash cow. We know that sports is always a good revenue producer. But on the content side, how do you get the same type of subscriber growth if you aren't spending on the content? I'm also looking at Pepsi. They did deliver better than expected earnings for the fourth quarter, significantly better than expected earnings. Those shares up 1.8%. What I find interesting is the increase in the dividend. How much do we see that ongoing? That the companies that have the cash aren't investing in growth. They're giving bigger dividends. We're seeing this in the energy stocks, and we're seeing this in certain, in the share buybacks because...
Tax them. Tax the dividends. Tax them. That's not my call, just to be clear. I'm just saying, off the back of the State of the Union earlier this week, it just seems like, if you're not investing in your company, those excess profits, tax them.
Well, okay, that's the political side. Okay, that's the political side. But I will say that investors are rewarding those dividend payments and share buybacks pretty substantially. And when the energy companies don't do that, their stocks go down, even if they've delivered incredible earnings.
The whole point,
you
have that excess capital, return it to shareholders. They invest it in something else more productive that might need to invest. And isn't that the whole theory?
Well, perhaps. I'm also looking at Hilton, just to move on quickly. Hilton shares are higher by 2.5%.
She's not hanging around, is she?
No, but this to me is interesting because the consumer story is very strong. And that is what we saw in these earnings. People are still traveling. The experience is still there. Service sector is still very strong. And this is what everyone, John, is talking about when they talk about the inflation that still is coming, that hasn't dissipated, that we might be seeing somewhat in the goods sector.
Things are so great that Disney's cutting 7,000 jobs. Awesome times.
You're just going to troll on me. You
But it
call
really
me brutal.
underscores the jumble that's out there.
But thank you. That's a very well said, Tom.
Did I do okay?
You did great.
Okay. Moving on right now. This is a joy.
So did you.
Thanks.
I want to tell you about one of the jewels of the Bloomberg
yeah.
terminal. It's called BTMM Go, and it was religion long ago and far away when there was gravity in the market, as Nassim Taleb puts it, that you would go to BTMM Go many, many times a day. And John, you know, I'm sorry, we're there. I mean, BTMM Go, we're back to that world.
What would you learn from that, Tom?
I would learn that there's real rates, there's higher rates. All of a sudden, there's a changed attitude, which a lot of younger people have never witnessed before.
Is that volatility from last year going to come back?
Yeah, I know. I don't know if the volatility is going to come back. It's a whole new world after all. It's back. We're back to a world before Harry Styles was in One Direction. That's how far back we are.
Is that like 2010?
Yeah, we're back like, 28,
Is that your
29.
marker?
When he sees us going, why am I here?
He wants to start singing.
Global head of credit strategy and One Direction fan at Credit Sites, Winnie Caesar, joins us this morning. I'm sorry, it's a whole new world after all, and we're back to what we remember a long time ago. Is that true?
It is true, and credit investors are rejoicing. Absolutely. We have yield again in the bond market. If you look at USIG relative to the S&P 500, it looks so attractive compared to where we were for most of the post-GFC decade.
David Leibowitz at JP Morgan calls it a dead cat bounce. Did we have a dead cat bounce here? Price up, yield down?
I mean, I don't want to call it a dead cat bounce because we exactly hit our targets for forecasts. So that feels pretty good. I have some validation there after people were telling me we're too constructive. I don't love it. 3 weeks into the year, hitting our targets, that part doesn't feel as great. So I do think that there's reason in the short term for some tactical caution. We're a little worried about next week's CPI print.
Tactical caution. What in God's name does that mean?
Tell us what tactical caution is.
Tactical caution means that don't buy everything right at this moment. Maybe put on some hedges if you can do that in your portfolio. The long-term view, we still think looks really good, especially for IG and high yield. But in the short term, expect some volatility. We could see a little bit of the same type of directional movements that we saw for a lot of last year, where we saw kind of the volatility surrounding duration and concerns around where exactly is the Fed going to go, where exactly is inflation going to go. But we do think that you have to look through some of the noise or the jumble, as you would say, Tom, in the data, and kind of play for the long term in the credit markets.
Tom, what's that line the military uses? Strategy didn't survive first contact?
Something
like that.
But,
it feels like 2023. You come in, you've got a 12-month plan.
Mm-hmm.
You see 1 year in about a month.
Mm-hmm.
What do you do then?
So then you have to start looking at 24, to be honest. And, a lot of people are looking at 23 as very much a transition year. Using the word idiosyncratic, there's definitely going to be some single name pressures, some acute issues in that part of the market that we are going to see the uptick in defaults. But then as things start to normalize again, and we don't expect the Fed to be pivoting or, cutting rates into 2023 at all. We do expect them to be on hold. But we think that the credit markets can really withstand a lot of that elevated yields, especially as liquidity has returned to the market, as we've seen investors really step up and say, hey, bonds relative to equities look pretty good again. And that feels like a really good long-term trade.
I am looking at 3-month 30s, the entire span of the Winnie Caesar world. And I'm looking at a chart back 30 years I've never seen before. Your world is a never-seen-before world. I've got curve inversion of 105 basis points. 114 was the recent low as well. How do our listeners and viewers that are scared stiff of the stock market participate in a never-seen-before world?
That is a great question. So
what? Okay there.
I really
I got an overhang from
it.
Lay's potato chips, so I'm not thinking clearly today.
You need a palate cleanser. So I would say that what you need to do is focus on where there is opportunity to capitalize on other relative value kind of wonkiness in the market. The spread curve in investment grade is inverted. That is historically very much an anomaly. So what you should be doing is looking at the belly of the curve there. If you are interested in picking up some excess return opportunities, look and see what is fundamentally sound over the next, call it 2 to 3 years. We still really like the energy sector. We still like the high yield market in terms of it being an up in quality trade relative to what it was historically. The credit markets are very different than they were, over that time frame that you have your chart up of 3-month 30s as well. And so you do have to give a lot of credit to what is now different and better, and then also what is a little bit scarier, which is definitely that very long duration kind of IG trade where bonds are super discounted in terms of dollar prices, but spreads are really not that attractive in the super long end. So that, should I be buying all the duration right now? We have not been taking that trade.
We were focused last year on just the actual level of yields, all-in yields, and how much more expensive it would be for companies to borrow. But were we looking at the wrong thing? Is it more the stability of rates where they are, the sense of predictability that gives a green light to invest?
I think that that's a really good point. I think that as companies are trying to figure out how do I manage my balance sheet, they're very focused on what is my access to capital. If I go to the new issue market on the wrong day, am I going to be severely punished? That was the case last year. There were a lot of very punitive days in the new issue market. This year, so far, that has not been the case. And in fact, it's been the opposite. The issuers could come back and be very much rewarded for it.
Winnie, thank you. Winnie Caesar there of Credit Sites. Wow, things have changed in a month. What did we say at the start of that conversation? We've seen about a year's return in a few weeks.
Which is the reason why some people are getting uneasy. The story, though, and what Winnie said there about how it's a higher quality asset class than it used to be is interesting. And it shows the lag effect of all of the cash on the balance sheets and the strength in the companies and how much better quality some of these left for dead companies were. At least they were left for dead perhaps in the 80s, not anymore.
Or did we just get this massive cohort of BBB companies get downgraded to junk? And now junk has gone up in quality because of that.
I've actually gotten a couple notes about the downgrade trade and how excited people will get if things are downgraded because then it goes on sale. I mean, literally, if you've got to let the fear and the greed continuum, you're still kind of heading over on the fear.
Just briefly, what happened with that? I remember years and years, Lisa used to write about it every other week. And I'd go on TV and quote Lisa. And I'd be like, Lisa says...
Ferro's a genius.
Lisa says that BBBs are a huge, huge issue, and this could be a problem. And then we've had the pandemic. We're facing a downturn. If it materialises, I don't know. What happened to that big risk that we all used to talk about?
Well, so the big risk materialized with the pandemic, right? We saw that massive downgrade wave at the exact right time for those companies because all of a sudden the Fed stepped in and said, hey, guess what? Corporate bonds are A-OK. If you are a fallen angel, we're going to make sure you have access to capital.
Some money.
Everybody got money. Yeah. So now the trade is a little bit different. And I think that there is much more of a motivation for management teams to move back up towards the BBB rating. Or if you are BBB to say, okay, actually, we don't want to get that downgrade to BB right now because our borrowing costs are gapping significantly higher. It's a harder market to kind of access the type of liquidity that we need. So I do think that we are seeing a shift in terms of how people are thinking about ratings from a management perspective.
Chair Powell's no longer the Oprah of fixed income. Basically, that's the change.
Yes,
that's the change. I mean, my words, not yours. You couldn't write that, of course.
You got a car.
You get a car. You get a bailout. And thanks. All right. You know, practice that one, Tom. It's lost on Tom. In the next segment, Jim Zauter, co-president of Apollo Asset Management. Looking forward to that conversation. Really looking forward to that. Big chat coming up, Tom, on private markets.
It's timely. It's really, really timely, actually, to say the least.
Looking forward to it. Equity futures up by 0.7% on the S&P. Live from New York, jobless claims 50 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's day 2 of Volodymyr Zelensky's surprise tour of Western Europe. The Ukrainian president is in Brussels today after stops in London and Paris. He's been thanking allies for their support and urging them to provide more weapons for the fight against Russia. Rescue crews continue to pull survivors under the rubble of collapsed buildings in Turkey, but hopes are starting to fade more than 3 days after 2 massive earthquakes killed over 16,000 people in the country and Syria. The U.S. has positioned an aircraft carrier in the area for assistance. First Abu Dhabi Bank is pressing ahead with a potential offer for Standard Chartered. Bloomberg has learned that a bid is possible once a cooling-off period required by UK takeover rules lapses. First Abu Dhabi is exploring an all-cash bid in the range of $30 billion to $35 billion. And in pro basketball, a mega deal involving the Brooklyn Nets and the Phoenix Suns. There are multiple reports that the Nets have agreed to trade superstar Kevin Durant and TJ Warren to the Suns in exchange for 3 players and a series of first-round draft picks. Well, that completes Brooklyn's dismantling of the team that once included Durant, James Harden, and Kyrie Irving. And Disney CEO Bob Iger plans to cut 7,000 jobs as part of a dramatic restructuring of the world's largest entertainment company. Disney is seeking $5.5 billion in cost savings, with more than half of that coming from its budget for movies and TV. Iger is also reorganizing the company into 3 divisions. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We are seeing that effort begin to pay off, but we have farther to go. And it might be a long fight, with interest rates higher for longer than some are currently expecting. But I will not hesitate to do what is needed to get my job done.
Governor Waller of the Federal Reserve with the message. Overwhelmingly, the Federal Reserve on the same page here. Official after official, Tom, the message pretty clear. More hikes to come. More hikes to come.
14 people spoke yesterday, and I think we got 14 answers. I didn't see Bullard didn't play, right? Bullard wasn't there.
I think he's coming up later this week, tomorrow.
I'm sure. I think he's.
At least he's memorised the diary.
Everybody's on the same page, right? Everybody's on the same
Essentially, so far, so
good. Did David
yeah.
Rubenstein interview all of them?
No.
Okay.
Maybe he wants to. Perhaps he will later this week.
Oh, it's interesting, but I'm looking at the market, and I'm sorry, I walked in green lift. I mean, that's all we got.
Hey, the lift sticks, Tom, up 0.7% on the S&P.
It's so important and so news now. We're going to, instead of chatting here, we're going to get right to it. Mr. Zelter, Jim Zelter is co-president of Apollo Asset Management. They are on a roll. We all know that. We thank them for Torsten Slok and his wisdom on a daily basis, and he'll try to keep up with Mr. Slok. Jim Zelter joins us this morning. Jim, there's a fire sale going on in Zurich, Switzerland. I believe you guys have a nodding acquaintance with it. Describe the theft this morning and yesterday as Apollo took on assets from a beleaguered Swiss bank.
Well, good morning. Good morning, all of you. For us, the transaction you're referring to, the securitized products business, we've thought for years that there is a great theme going on, a great evolution of a lot of assets that are and strategies that are within the banks are moving to the alternative side of the business. And SPG is it's really a finance company of finance companies. It's a massive business with a 20-year track record, and bringing that team on, 250 plus people, 300 origination platforms underneath it. It really is our objective of fixed income replacement, getting investment grade returns, but doing it in a more thoughtful, actually candidly a less risky manner. So a massive transaction for us. The way we're able to do it was very nuanced. We'll talk about that in our earnings call today, but we're very excited. And we think this whole area of private credit, I saw your past guest, this is the golden era for private credit. Rates have been rising. Economy is doing pretty well. You can get double-digit yields, but in this particular, in the securitized products business, it's really investment-grade risk at tremendous spreads.
I learned a long time ago, Jim, that the heart of this, as you correctly mentioned, is you need to retain 250 warm bodies as you bring them over. Explain the incentive, how you're going to incentivize those people to join Apollo.
Well, like we've done for decades, Tom. I mean, we bring them in. We have an aligned business plan that's not just about growing the assets, but doing it in a productive way where credit losses are negligible or zero. And we're aligned on the trajectory of the business. We're really aligned on what the investors get at the end of the day. It's all about investor returns. And we're aligned at making a productive business that's accretes to the shareholders of Apollo. So if we do that in an aligned basis, which we've done, that's the success long term. And I think that what this management team who is there, they're extremely excited to be part of a business where we can offer this type of long-term trajectory in terms of benefits and compensation, but also in alignment with the shareholders at the funds, alignment of shareholders at Apollo, but also the most critical aspect is long-term predictable capital. So they can go about their business, they can execute their business and grow their business with long-term sticky matched assets. That's really the key to success. It's no more complicated than that.
Hey, Jim, you've deployed a lot of capital very recently, and we've all seen the correction take place in public markets. There's been this bigger conversation about whether we've seen the correction take place yet in private markets. I just wonder how you think that's going to play out through the next 12 months and what that might mean for the volume of transactions we can expect from you over the next few quarters.
Sure. Well, for us, our discipline, our determination, the theme we've always talked about here is purchase price matters. We're finally in an environment where for years, folks asked us, how are we going to perform in a higher rate environment? I think the results of the last 12 months show us that. For us, this is easily the best time to be an investor in new issue vintage credit, the best that I've been here. I've been here 17, 18 years. You're getting double-digit returns by lending at the top of the capital structure. So, voracious demand. And on the portfolio, as you're asking, we're not seeing, it's certainly a very bifurcated economy. I'll let you ask Torsten the economics questions. But for us, if we have followed this discipline of our mantra of purchase price matters, we're lending to great companies that are, well positioned. And the reality is it's very difficult to put one term on which way the economy is going in terms of, upside, downside with rates. It's very bifurcated. You have many industries that are consumer-led, the cruise industry, hospitality, entertainment, travel, they're doing quite well. Those that are much more hard industry are having a little bit more challenging time, the autos and such. But for us, there's a lot of companies that need capital. We've expanded our capital base, not only the size of our capital, but what puts us in a unique standing is the breadth of our capital. We can offer scale solutions, down in the mid-single digits, which are very accretive to our, spread-related earnings of our retirement services. And that makes a lot of sense for us. We're really thinking about that incremental return for a unit of risk. And for us, it's a great time to be in our business.
Do you expect that we're going to just miss a default cycle altogether then?
I think, Lisa, it's going to be one where certain industries get hit a bit harder. And it's going to be, we always talk about, our default's going to go from 2 to 3 or 4%. They probably will tick up higher in 23, 24, but it's not going to be broad-based across the high yield sector or the leveraged loan sector. It's going to be concentrated in 4 or 5 industries. But I would say that the theme that you're seeing in the last 2 weeks in your show, companies are much more focused on returning capital to shareholders. We're not in that zero cost of capital world anymore. What's going on at the big oil majors, what's going on at Disney, what's going on at a lot of other companies, these companies now are very focused on cash flow generation. And that's what we've done for 32 years. That's a playbook that lasts, it's robust. But for us, there will be a certain degree of a credit cycle, but it's not going to be broad brush across every asset, or at least we're not running our business right now with that intention in mind.
There was a long time when private credit was largely the sphere of institutional investors. And then over the past few years, pre-pandemic mostly, there was a real push into the individual investor. How much is that still the opportunity versus going back and really doubling down on institutions?
Well, I think they're both growing. The institutions have been in this business for 30 years in terms of what they did in private equity and then all the other alternatives. And in the last 3 or 4 years, the global wealth channels around the globe, which are voracious, the amount of wealth that's been created, not only in the U.S., but in Asia and in Europe and India, in Hong Kong and such. There's a voracious appetite for high quality managers that have proven themselves in products that make sense, good education, appropriate fees, appropriate liquidity. But we think it's a once in a decade opportunity. It's not surprising that a handful of firms are very focused on it. When we did our investor day 16 months ago, it was one of our 3 critical priorities or initiatives, along with origination and capital solutions. But it's still front and center for us. And certainly I think this rate rise actually makes it quite attractive for many folks to enter this world. And we're building a tremendous resource base to be able to really create products, invest appropriately, and service the clients necessarily.
Hey, Jim, one final question. Is Manchester United a once-in-a-decade opportunity?
Well, listen, I'm more focused on U.S. sports, but the reality is there's an amazing amount of sports ecosystem financing going on, and we expect to be part of that going forward.
Do you want to elaborate on some of that?
Well, I just think what you're seeing right now, these sports are global. I know you and Tom have your view on certain teams in the Premier League. I wouldn't even think about getting in the middle of you two on that one.
Jim Zatter of Apollo. Jim, if you ever want to look over
Never
there,
coming on
you know,
again.
we can consult. We
That
can
was
work that out,
fantastic.
TK. Maybe you can take a stake in Spurs.
I think, I'd call Mr. Levy and have Mr. Zelter over to,
Just, we'll
partake
arrange.
in the experience
we'll
with the
mediate.
tots.
We'll mediate.
Yeah.
Thank you, Jim.
We'll take some fees for that too.
Yeah,
of course,
2 basis
Sort of invest in Surveillance Plus.
Securitize it.
2 basis
Sell
points
out.
and a 6-pack of John Courage. It'll be great.
Jim, that was great. Jim's out there of Apollo. Fantastic to catch up with him, Tom.
I'm fascinated, and this is a whole burgeoning thing, and we've never been here, John. How do these guys respond when we disinvert? Someday we're not going to have curve inversion, and I wonder what the world's going to look like.
I'm fascinated also, Tom, just the process of price discovery in private markets over the next year.
Well,
It's,
and a lot of people saying,
percolating.
if you don't discover the price, maybe it didn't happen.
just like that. That's very philosophical, that is.
I've heard that before.
Nice, Lisa. That's
Thanks,
nice promo.
thanks.
It's true that we're not going to go into recession anytime soon. The economy just has too much forward momentum.
Everyone is waiting to see how bad things are going to be. And I think that what that is implying is, hey, right now it's really not so bad.
To us, the U.S. equity market is fighting the Fed big time.
It looks like a 25 basis point rate hike is quite likely in March. The question is going to become May and June.
Is it possible that after some pause, the Fed will have to raise rates again, make some adjustments higher? Absolutely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Staggering to that inflation report on the 14th. Maybe a jumble today. Futures up 27. The NASDAQ up a stick as well. And, John, where are we? The NASDAQ up 14% year to date.
Flying.
SPX up 7% this way. The Dow Jones Industrial
Nice.
Average underperformed.
Oh, what happened?
2%.
What happened there?
I think it's a movement to risk. That's really what we're talking about here. Is a massive call. FTSE at a record,
Record high
3
there,
days
yeah,
in a
so
row.
Lisa
There's
mentioned
something
Disney.
going on here.
Let's set the stage. Disney, 7,000 jobs to go. Affirm, that buy now, pay later firm, we're going to see a fifth of the workforce go there as well. The mortgage business at JP
I'm glad you bring
Morgan
up
reportedly
Affirm.
making some cuts. Put it all together and then compare it to what we're going to see in jobless claims in 29 minutes. Jobless claims still sub 200K. Lisa Shannon of Morgan Stanley, she was in that nice opening moment there at the top of the hour. She said there's a massive disconnect in equities. I think some people would say there might be a disconnect in some of the data we're seeing.
Well,
Tom, in some of the incoming information, some of the things we're hearing from
You got to
companies.
stay with us for at least the next 15 minutes because the woman that's coming up here says something isn't right, and that's going to be the theme. And we know, John, in the equity market, you go to bonds to find what's going on. Lisa, what is going on with curve inversion now a full negative 84 basis points? I mentioned the 3-month 30-year is out to truly 30-year inversion.
The bond market believes the Fed is going to raise rates beyond 5%, that 5.1% average. That is the takeaway. They believe the Fed. What they are perhaps also believing, and this is where it does go in tandem with equities, that it's going to be immaculate disinflation. I mean, I keep going back to that you're going to get inflation coming down without the pain that Jay Powell talked about at Jackson Hole. And that's the disconnect in markets. Can you get inflation coming down to the Fed's goal without that pain, without a recession, without a material uptick in employment and in wages?
John, in Germany, immaculate disinflation.
Yeah, you want to call
Very
it that?
immaculate.
When you move from 10 to 9? Is that disinflation? Tom, going from 10 to 9?
I think it's
Some people would say that's
nuanced.
disinflation. The Germans would say it's a problem.
I would take the point we're all waiting for February 14th for different reasons. There will be the acquisition of roses by Mr. Farrow. Mayor
Well,
Adams called me.
usually you get complaints from me about the cost of roses.
We do.
I don't think we're
We-
expecting
the
any.
racket
Are we
is-
expecting any disinflation?
No, I don't
next
think
week
we'll
on
see
that
an
front?
immaculate
We never do.
disinflation.
You'll tell us.
on
Do
roses.
you want my rant now or next
No,
week?
no, we'll take
wait
it
till
now.
next. No, we'll take it next week. He's just pounding the table.
Ready to go.
What are you buying?
I haven't gotten there yet. I have people sending me stuff. I actually have retail people
send you
sending me
Valentine's
photos.
gifts.
I love it.
like
I don't know
I've
how
already
to get
gotten
my
the flowers.
What an
emails.
absolute stud. You know,
No,
what
no,
are you
no,
getting?
no.
He just lays back, sitting there with his tang and says,
no.
People have been
people
sending
send
me
me
stuff."
stuff.
No, they're sending me photos. They somehow
does
get
Mrs.
my
Keene know
email,
that?
and Mrs. Keene has them sending me photos of stuff.
Right. What?
And I'm
was
just
gonna
shocked
ask
when
what
I see
of, but
them.
I don't want to go there. Futures on the S&P
Let's save ourselves with the data
by
check.
0.7%. People send you photos. Okay. In the bond market, yields look like this. Claims 26 minutes away. Your yield on a 10-year down 2 basis points, 358.80. TK.
It's interesting here, and I'm going to go to the 2-year yield, John, 4.43%. I got curve inversion, negative 84 beeps. There's something going on here.
Something is going on, but Tom, look how much has changed already. 2-year right now, 442. To close the year last year, 442. So we have round-tripped on a 2-year yield, Tom. And a 10-year, I think a 10-year is something like 30 basis points off the low of the year, which was back in January.
Let's talk to someone in the trenches here of what do you do given the jumble. And I love what Victoria Fernandez and Crossmark Global says. They just simply say something isn't right. That's dead on, Victoria. What isn't right?
Yeah, I wish I knew, Tom. I wish I could lay it out that simply, but we just don't know. You're looking at this data and you're saying the puzzle pieces are not fitting together, because if you tell me we're going to have inflation of 5 to 6% with the S&P valuations of 18 times or a little over 18 times, that I've got the Federal Reserve and central banks globally saying we're going to continue to hike rates, you've got an inverted yield curve. I like to look at the 3 months to 10-year. That's 110 basis points inverted. And you've got money growth, M2 money growth, falling at almost 4% annually for the last 3 months. You look at all that and say, oh, no problem. The economy's in great shape. And I just don't believe you on that. But you can come and tell me consumer balance sheets are good. Corporations are cutting costs in order to help their margins. The labor market is super strong. And let's look at credit. I mean, with Lisa there, we can talk a little bit more about credit. We see 160 billion of issuance in the U.S. in the month of January, and credit spreads are tighter. So that tells us that maybe we aren't going into recession. So tell me how you fit all these things together. We aren't really finding a solution right now, which means more uncertainty, more volatility. And for us, that means you have to be very cautious with your portfolios.
You're in the same camp as Lisa Shallard at Morgan Stanley, it seems, 24 hours ago, who said almost exactly the same thing, said there was a massive disconnect in equities, went on to say history is not kind to these kinds of massive disconnects. Do you think there's a bigger disconnect in equities or credit?
Well, I think the credit market is coming around. Lisa just mentioned a moment ago that the bond market is actually believing the Fed, and I think that's somewhat new. Let's look back a couple weeks ago when we saw yields drop pretty dramatically here in the U.S. And interesting enough, global yields did not follow U.S. yields lower. And it's like the U.S. market was saying they didn't believe the Fed, but they started to come around after Powell's speech this week. So I think maybe the larger disconnect right now might be in the equity market. A lot of the technicals are saying this is more of a sustainable rally than what some people believe, but we have to be careful because, look, yes, we had a golden cross, but historically there's a tremendous amount of volatility and whipsaw movement around a golden cross. We're seeing more and more equities trade above their 20-day moving averages. But again, you have to look at the trend lines, and right now they're still down. So I think that's where we see more disconnect. I just want to be cautious. I don't want to buy into something that turns into a bubble. I would rather be a little bit late to the party and be more sure of what we're seeing.
Although the question around being conservative has been a serious one over the past 12 months because some of the more conservative instruments have seen some of the worst losses going back decades. David Lebovitz of JP Morgan was on just moments ago, and he was talking about holding a greater amount of cash in his portfolio than before the pandemic. Are you in the same camp?
So you always like to hear people say cash is king, right? But for us, we feel like you need to be invested. You need to have a balanced portfolio so you can be tactical and take advantage of the moves you're seeing. So have you added some fixed income? I hope you did. I hope you added it last year like we did. We extended duration in our portfolios. Once we hit that 4%, 4.25 on the U.S. 10-year, we were adding some cyclicality to our equity portfolios because we had a lot of staple names. So trying to balance that out. So I think you need to be tactical. Take a little bit of a short-term view and make small trades. Don't make big bets in a market like this. That's where I think people make mistakes, Lisa. Let's be tactical. Let's be opportunistic, but you also have to be cautious and be a little more conservative in your allocations.
Victoria, this was great, as always. Victoria Fernandez there of Crossmark Global Investments. I think capturing the feeling a lot of people have right now, Tom.
Yes, yeah.
Especially those that missed out on this rally here today. This feels odd. I don't know what to do with this.
Yeah, exactly.
Let's frame this correctly, and the value of having Victoria on his Crossmark is it's not big banks, it's not strategy, it's not marching orders on a Monday, this is our bank message or whatever. Crossmark is out there with real portfolios, real money at risk, away from the idiocy of the island of Manhattan. And that's the massive value where Victoria and her team are saying something isn't right. I mean, everyone feels
sometimes it takes confidence to do that. I think a lot of people on TV, they think the secret is have conviction, have something to say, have absolute belief in it. I think you come into this year and look at the incoming information. You see jobs come in at 517,000, unemployment dropped to 3.4%, claims at 183,000, and we'll get an update on that in 20 minutes. And then you see wage growth not accelerating and disinflationary trends starting to take shape, and you're just wondering, where's this one going?
Yeah, and people talk about a rolling recession, but I love Victoria's comments basically saying it's not great to hear from your money manager that something's not right because it's kind of vague. But if you aren't confused with where the economy sits right now, I feel like you aren't looking at all the data, and that really is the takeaway from all of the different signals that we
Julian Emmanuel said exactly the same thing. Julian was saying, if you're not confused right now, you're not paying attention. And I think that sums it up, Tom. If you're not confused right now, you are not paying attention.
Yeah, I agree with that, but I will also say, and this goes back to Ralph Van Kapoor's heated interview, the giant technician, where he said October was a low. This is the kind of jumble and something isn't right you get before bull markets happen. There's a lot of gloom. There's a lot of people not playing. I go to that JP Morgan chart of 3 days ago showing the huge amount of people that have disbelief in this market. And I'm sorry, I walk in, and John, I look at the NASDAQ up a stick, and I really don't know why, other than some good earnings.
It's like David Leibovitz sat there and said some of the earnings haven't been great. Yields are actually higher again, but tech's rallying. And he couldn't figure it out. It's like all roads lead to the same question. Why is tech rallying? Why is tech rallying and yields are higher?
Because they believe in Lisa's immaculate disinflation, period.
Is that really what it is?
I think it's a duration play, and as somebody
Short
said,
squeeze.
I'll give credit.
Positioning story.
No, they're having they're
cost rationalization. Yeah,
they're
then all of
trying
a
to
sudden
act like
cuts.
adults.
All right, maybe.
But the cost story is a factor.
Maybe it's the right answer.
Look at Meta a number of months ago, who really kicked this all off. Facebook has rallied so hard since then. How dare you try and overspend in a rising interest rate environment? And this market slapped them so hard they came back with some massive cuts.
Although still we haven't really addressed the existential questions around the growth in their platform, right? So again, there still are some of these hanging over questions, but are cost cuts enough to cut to growth?
We're going to see. Made me think of Credit Suisse. Where's that stock now? Credit Suisse at the moment, down 7.7%. It's been a rough morning for them, hasn't it?
It's been a tough time. How do they bring back? How do they bring back all of this?
How do you say in February, Tom, 2023 is a write-off? See you in 24.
To their credit, their PowerPoints are clear and hugely detailed. What a mess.
Huge mess. Stocks down 7.7%. Equities up 0.7% on the S&P.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky is in Brussels, the third stop on his quick trip to Western Europe. As he did in London and Paris, Zelensky is seeking more military aid for the war with Russia. European Parliament President Roberta Metsola said allies should consider sending long-range missile systems and fighter jets to Ukraine. The death toll has now gone over 16,000 from earthquakes that struck Turkey and Syria. Rescue crews were still finding survivors more than 3 days after the quakes hit. Meanwhile, the U.S. has deployed an aircraft carrier to the region to provide assistance. Credit Suisse warns it faces a substantial loss this year after clients withdrew a record $120 billion in funds in the fourth quarter. Confidence has been deteriorated in the Swiss bank, which posted a fifth straight quarterly loss. We spoke with CEO Ulrich Korner.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, to create a new Credit Suisse, much more focused, simpler, built around client needs, in the midterm very profitable.
Credit Suisse's trading revenue has plunged 96% in less than 2 years. And PepsiCo reported fourth quarter profit that beat expectations. It's a sign that shoppers are willing to pay more for higher prices set on beverages and snacks. This year, PepsiCo sees organic sales growing 6%. That also beat Wall Street expectations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There is an ongoing operation to recover the balloon's components. We're analyzing them to learn more about the surveillance program. We'll also share relevant findings with Congress as well as with our allies and partners around the world. We already shared information with dozens of countries around the world, both from Washington and through our embassies. But we're doing so because the United States was not the only target of this broader program, which has violated the sovereignty of countries across 5 continents.
Antony Blinken, the US Secretary of State, the address that he didn't think he was going to make a couple of weeks ago. He thought he was going to Beijing, didn't he?
Yeah, he thought he was going to come back and say, well, we seem to have found some sort of floor.
Put
and
a floor into the relationship. It's all good.
Common agreements, and now we've got a surveillance balloon.
Amazing. Futures right now, positive 0.7%. We are about 13 minutes away from jobless claims in America. The number last week was just stunning, 183,000. Lisa's gone through the estimates a few times this morning, but worth repeating. Looking for that number, Tom, to come back up to 190K from 183. I guess we'll find out in 13 minutes.
And then you dovetail it with the JOLTS and some of these other surveys. And what I'm hearing, particularly from the adult Michael McKee, is there's enough oddities going on that creating short-term moving averages of this is hazardous to your health.
True. But how many people have been laid off by tech firms who have just walked into other tech jobs?
That's a great point.
Other openings.
You wonder about particularly banking, banking area. They were trying to hire all the tech investors, all the
For
tech
ages.
strategists.
Trying to convince
so
a new generation that this was the place to be.
Maybe now's their moment.
You know, we'll give you free things. What were they giving away in the pandemic? Like a Peloton over at Jeffries? Wasn't that what they were doing? Like a Peloton
I wasn't
subscription?
keeping track.
So no, it was crazy at one point. Do you remember the analyst community? It was pay rise, pay rise.
200,000.
Get a Peloton. You know?
Never been on one.
No, neither have I.
Why are you shocked?
No, I'm not shocked. Have they got one in your gym?
No, I don't think so.
Okay.
We have other ones. We have like fake Pelotons.
Fake Pelotons?
Yeah.
Have you tried one of those?
No.
Okay.
I don't.
I'm just asking.
I don't do that. We're going to continue forward here, and we do this. Of course, Ben Stiller off a couple movies with Jennifer Aniston, and we all know Ben Stiller. And there's a guy named Sean Penn, and we can add to Stiller and Penn someone else sanctioned by Mr. Putin. Daniel Tannenbaum, the actor, joins us now. With Stiller, with Penn, there is Tannenbaum, and he's global head of anti-financial crime practice leader at Oliver Wyman, and in the timeout chair, the Putin timeout chair from the Atlantic Council. What's it feel like to walk down the streets of New York sanctioned?
I wear it as a badge of honor. I've done something right to garner that kind of attention. But it was definitely not on my 2022 bingo card to be banned from entering Russia. So that was a surprise.
I can make jokes about it, but this is serious stuff. How did you and Oliver Wyman react to this? Is there a change in your life that you're now sanctioned?
So there's no change in my life. My name was spelled wrong. My company's name was spelled wrong. So my firm's reaction was, well, if they spelled your name wrong, are you really sanctioned?
You're not technically sanctioned, right?
That was kind of the view. So no, everyone took it better than I would have expected, but I have not changed my life too dramatically as a result of this.
From a policy perspective, though, what do you make of the growing push, at least by a segment of the U.S. population, mostly Republican, against providing much more aid to Ukraine in this fight, given the longstanding tension with Russia?
I think it's going to earn us another Zelensky visit, frankly. You see he's on the European tour right now, to continue to generate support, and especially February 24th is the one-year mark. With all of the focus on other issues around the world, which is understandable, he needs to continue to rally support around the world. I think when push comes to shove, there's not unified Republican support to go against aid packages to Ukraine. I think the focus now, and I can certainly appreciate this having worked on other aid packages in other countries, is just the accountability of where the money is going to ensure that you can really track where it's spent, what it's spent on. But I honestly think when the rubber hits the road, that will not be a popular opinion, especially with how strong Zelensky and his administration is from a PR standpoint.
Although from a policy perspective, we have moved away from the possible escalation debate, and it has sort of moved into the backseat of people's consciousnesses, even as people continue to fight and continue to die and the different travesties continue going on. Can you talk about why the discussion around escalation no longer is present in the conversation?
When Germany was sending helmets, when we were sending bullets, there was talk of escalation. When there was talk of tanks, there was talk from Russia of escalation. Now, Zelensky is after fighter jets, and there's talk of escalation, but Russia hasn't necessarily made good, at least to the scale of the bluff and bluster, with making good on those threats. It really is hard to see what that line is, and we hope that it stays, well, we hope that it ends. But realistically speaking, I mean, it's kind of the boy who cries wolf at this point.
Dan, there's been a school of thought for a long time that trade prevents conflict. It hasn't worked in Europe. There's been a school of thought that maybe sanctions could work as well. Any evidence that sanctions are working anywhere?
I think about a year ago sitting here or there or somewhere in this area talking about this. Sanctions and isolation were never going to keep Russia out of Ukraine. Sanctions plus military support was always going to be part of the calculus. Now, that being said, I mean, Russia is very rapidly working towards economic obsolescence. They're working towards status of countries like Cuba and Iran, where they're going to have extremely few trading partners. There's talk of the Iranians building a drone plant in Russia. I mean, Iran's just happy to have an ally at this point. So realistically speaking, the world has proven and continues to prove it doesn't need the Russian economy. And this is the miscalculation from Mr. Putin on this entire crisis.
Yeah, I think when I mentioned this to you before, Dan, one of my great first missed calls was the effect of sanctions in South Africa and what they do. This is, I believe, 1984, 85. What's the next marginal sanction that can have impact?
Well, I mean, speaking of South Africa, they're in the process of holding joint military exercises with Russia and China in the coming weeks. And they've already been warned by the U.S. government that facilitating any sanction circumvention will not end well. There's been a lot of threats of secondary sanctions like that have been levied on Iran. But realistically speaking, there's still more levers that can be pulled on this.
Just quickly, John talked about trade preventing conflict. And it makes me think about Europe with its relationship with China at a time of rising tension. Is there any probable pushback to the incredible trade relationship that Germany in particular has with China at a time of rising tensions?
I mean, I think looking at the trade data, there's no evidence of a decrease in trade through these corridors. The trade is relatively static, and I think that is why when you've seen issues between the U.S. and China, China has taken a relatively measured response to chips bans, to other sorts of measures that have been placed on them, not just by the U.S., but by the Europeans. There is a recognition that China does need the West, and the West needs China. How that ultimately manifests itself from a geopolitical standpoint is a real question, but trade data still seems static at this point. There doesn't seem to be any material disruption.
It just seems to me, though, and to build on what Lisa said, that the two main geopolitical challenges that the U.S. faces right now, whether it's Russia or China, that Germany seems to be the weak link in both. What can be done about that? I
mean, look, right now you're beginning to see companies sit and war game what a potential escalation of Chinese aggression could look like from a Western resolve, from a sanctions standpoint, and what is the business impact? So you're seeing businesses that were caught flat-footed on the Russia invasion and what that meant for their businesses in Russia begin to look towards China and prepare accordingly to make sure that doesn't happen to them. Not to do anything preemptively, although there have been movements of supply chain out of China to diversify, but you're seeing a lot more companies take seriously what could happen to their businesses in the event that China escalates things, and to have a playbook on the shelf now.
How did they spell your name? Just out of interest.
They added a third N, which Ellis Island was nice enough to remove.
Okay, there we go. A sanctioned Dan Tannenbaum
Third N
of Oliver Wyman.
3 N's. T-A-N-N.
Tannenbaum.
Wow.
There we go. I mean, it was worth asking.
You'll never find me.
I was just... Coming up at the Open, Jim Bianco of Bianco Research, Megan Green of the Kroll Institute, Tony Dwyer of Canaccord Genuity. Fantastic lineup as we count you down to the opening bell in about 5 minutes' time. Mike McKee in Dan's seat, breaking down jobless claims for you.
I just noticed Tannenbaum's is cut and chiseled as Sean Penn. I mean, that's.
Do you think that they mistook him for Penn?
Yeah, I think
that's
so.
What happened?
Stiller,
Maybe.
Penn.
It's the nicest thing he's ever said to me.
It's possible.
Aww.
It's downhill from here, Dan.
Yeah.
Happy Valentine's Day.
Was that your gift to Dan? That's beautiful.
It's inflation.
Just lovely. Beautiful.
Bloomberg Surveillance, Lisa Abramowicz and Tom Keene, Jonathan Ferro on sabbatical right now. We have claims, and I want to take you back to that spring of 2020 when claims jumped from 199,000 to 878,000. That was the beginning of the shock of the American labor economy. We're looking for a suitable jump today. Michael McKee joins to brief us here on what we're going to see in claims. Survey 190. That's not a jump, Mike, is it?
The survey would not be a jump, and it doesn't jump very far. We do come in over expectations, 196,000, but that is still very low. So we're not looking here at a major change in the initial jobless claims numbers. Continuing claims do rise a bit, 1,688,000 from 1,655,000. However, that is not a significant jump either. It looks like what is happening is we are hearing layoff announcements that haven't completely happened yet, and that also a lot of people are getting jobs very quickly once they lose jobs, because that continuing claims number doesn't jump up significantly. So I think at this point, the jobless claims numbers aren't telling us a whole lot, except for the fact that this is a very strong labor market, and it just goes along with what Jay Powell was saying the other day about if you think labor is a cause of inflation, they got more work to do.
When we have a layoff banner, and it could be Disney today or whoever, how long is it till those numbers enter the Michael McKee world?
Well, it depends on the company's plans. First of all, they may cut a lot of jobs through attrition. If they are actually doing layoffs, people may be offered jobs in other parts of the company, but also they have to give what they call WARN notices, 60 days notice, sometimes honored in the breach, but that does push out some of the actual departures. And if you get severance and it's more than you would make in jobless claims, then you're not eligible for jobless aid until your severance runs out. So all this tends to delay the arrival of the layoffs, and I don't think we're going to see Mickey and Minnie in these numbers for a couple of weeks, if not months.
Meanwhile, we aren't getting much reaction in markets, which is, I guess, as you'd expect, considering these are somewhat noisy numbers, and it's very much in line with what we were expecting. What do you make of the belief in immaculate disinflation that seems to be sort of pervading markets, the sense that the Fed's rate hikes as baked in are sufficient to bring down inflation to their 2% target, despite the robustness that we see by every indicator in the labor market?
Well, it is a theory that's out there, and it was originally proposed as sort of a sarcastic idea that how could you have immaculate disinflation? Now it's beginning to look like they might be able to do something like that, but it's still way too early to tell. I will tout today, Rich Miller from our economics team has a story on the Bloomberg about rolling recessions, and I think this may explain something that a lot of people have been wondering about. You go back to the 2015 era when we saw a recession in manufacturing, especially in the oil industry, but it didn't show up in the overall numbers, but a lot of layoffs there. And this may be happening now. We're seeing layoffs in the real estate sector, in the mortgage sector, and that may move on to other sectors at a time when real estate then starts to improve. We're seeing some signs of that.
Michael McKee, thank you so much. Always eventful. He'll be with us through a very busy week, staggering out to Valentine's Day, when John Ferro will pay a lot of money for roses, and
people will offer
McKee
you
will
gifts.
talk about inflation as well. Futures up 33, NASDAQ up 1.2%. Lisa, we have an important point here before we get to Luke Tilley. We have moments ago new curve inversion on the vanilla 2-10 spread. Let me fully explain this. The difference in yield between the 2-year and the 10-year printed 85 basis points. It breaches through what we saw in early February.
What's interesting about this is where that inversion is being driven by. And it's being driven by a rally in the 10-year Treasury. It is not being driven by increasing expectations for Fed rate hikes. In other words, people are seeing even more value in buying 10-year Treasuries for 3.6%, which are yielding the least relative to 2-year Treasuries going back a long, long time.
We're back to December 7th on that. We're not through that. Maybe we'll breach the December 7th level of last year here in a minute. On the American economy now, Luke Tilley joins us, chief economist, Wilmington Trust. Luke Tilley, the state of the American labor economy, it's a jumble to me. Claims odd, jolts odd, everything odd. What do you and Wilmington Trust make of our job economy?
Yeah, it's obviously an incredibly tight labor market, as Mike was just saying. The low level of claims really syncs up with what we saw with job growth in the month of January. Interestingly, if you look at the non-seasonally adjusted numbers, you usually get 2.8 or 3 million lost jobs in January. This time around, this past January, you get a loss of 2.5 million jobs. Of course, the seasonal adjustment pushes that higher. And what we really see is in this tight labor market, employers are holding on to their employees. We know how challenging it is to hire people. So it's really more of a story of wanting to hold on to people. That's the story behind the strong jobs number for January. And we're also seeing that with the claims this morning. Mm-hmm. We think that the job growth obviously is very strong, but it's more about the differential. You just referred to the jolts, jumped up on a 1 month basis. It looks a little bit fishy. Before that, it had come down more than 10%, but it's really the mismatch that's going to matter more than total job growth, Tom.
Is wage growth going to cooperate so Lisa can see her immaculate disinflation?
Well, we've already seen, I hear people talk about, is it possible to have this immaculate, disinflation? It's easy to point out that we've already had it for 3 months, right? This is not just a one-off. You've got 3 months of much slower inflation while you still have the strong wages and the tight labor market. We think that it's going to get much more challenging when you get to the middle of this year and beyond because the labor shortages are going to persist. We also see supply chain challenges. And then also the energy transition is going to keep some upward pressure on inflation. So we expect it to keep coming down in the near term. We're encouraged that average hourly earnings actually were pretty mild with the 0.3% increase. And if you look at production and supervisory workers, the slowdown in wage growth from last year into this year is even more encouraging.
So if you do get some noisiness, but you do get this sense of disinflation just based on the year-over-year composition of the way that the data is drawn up, how do you then get confidence? How do you give confidence that there's going to be a stickier inflation later in the year when all anecdotal evidence is speaking to the other?
Yeah, well, we think that it's going to keep coming down on a year-over-year basis. As you point out, you've got those base effects. We just don't think it's ever going to really come back down to what we saw between the global financial crisis and the COVID pandemic. We've got higher inflation on a trend basis now, between 2.5% and 3.5% on a multi-year basis going out. It could dip pretty low in the middle of this year. We know what's going on with shelter. And even if we just see the shelter numbers flatline, that would imply some very low inflation numbers. Wilmington Trust, we're much more focused on 9 and 12 and 24 months out. And those higher inflation numbers are going to keep rates higher and actually offer some opportunities for investors. So it's not a whole lot of confidence, Lisa, about what the month over month or even to the middle of this year has a lot more to do with that longer term trajectory. We see those challenges. We also think they're navigatable.
Well, navigatable, which really speaks to the Torsten Slok no landing kind of scenario at a time when a lot of people are pushing out potentially even for years, any type of recession. Are you among those?
Yeah, it could go out or it could happen this year. We've got basically a 50-50 chance, we think, of a soft landing versus a mild recession. It's going to come back to employers. We know that employers are dealing with higher borrowing costs, a little bit of softening in demand. If they keep hiring, then, you've got consumers, you've got job growth, you've got wage growth, and that'll keep the economy's head above water in the middle of this year. If companies get spooked and those higher borrowing costs hit their capex and their hiring decisions, well, that's going to lead to recession. I actually think it's going to have a lot more to do with the lagged effects and all of the hikes that were last year, much more important than whether the Fed stops at 5 or 5.1, 1 or 2 more hikes here and there. Businesses are reevaluating those capex decisions now.
Look, you earned your stripes at the Philadelphia Fed, which has one of the most interesting research capabilities, given the terrain, given the geography as well. And to me, it really harkens back to the study of the core American economy, which I'm going to call domestic final sales. When you take out the foreign dynamics, the inventory dynamics, and you just look at this thing, domestic final sales, is it half full or half empty?
We've definitely seen the slowdown, and that's our preferred measure. It's a little bit like looking at core CPI, right? You strip out the international. We actually go with private final sales to strip out the government as well. And what we've seen there is an appreciable slowdown in the economy. I mean, it was just barely positive for the most recent GDP report, I think 0.2%. And what we see there is a natural slowdown that was going to happen anyway from COVID, but it's also the impacts of the Federal Reserve's policy. We know that residential investment has been hit very hard, and this is exactly what they're trying to do, is to engineer that slowdown in the economy. And Powell referred to this just the other day, the final sales numbers, because what we do see is that slowdown that should help to bring inflation down. And of course, we need to wait to see which way that breaks.
Luke Tilley, thank you so much. With Wilmington Wilmington Trust this morning. Lisa, it's a stunning chart, and you have a pandemic collapse to negative 9% on final sales to private domestic types, which Mr. Tilley talks about. And then up we go to the stimulus boom of a positive 15% statistic. That was for a cup of Tang. And then we come right down, and we're settling right now on a moving average basis, on any form of annualized basis, actually below where we were for 8-9 years.
And what's behind it, right? And actually, Justin Fox, a Bloomberg opinion contributor, wrote a column that's fascinating about how manufacturing jobs really are coming back to the United States in a way that they really hadn't for decades. You see certain areas of industries where the landscape has shifted, right? You could talk about globalization. You could talk about, the durability, the sort of, safety, the security of trying to diversify your supply chain. But that's what's perhaps underpinning some of the resilience in a labor market that isn't weakening.
And the view forward, and this falls back into the Credit Suisse soap opera, is the financialization of the elites in America, which is away from prosaic things like manufacturing, is now within a regime of higher interest rates, whereas Winnie Caesar said money actually costs something. Well, and it's a whole new world. Let's go to Disney. It's a whole new world after all.
Which really goes to the Mike Wilson view of things. Can you get an economy that's resilient, a no landing, and still get a rationalization in valuations based on money costing something? Valuations in the equity markets. And that's, I think, one of the questions. You get a reversal of some of that financialization of the U.S. economy that perhaps is getting unwound just a bit.
I talked about today, early morning, I talked about what I looked at first thing Monday, which was the value line geometric growth fund, and it gives you this ambiguity right now. It's actually behaving in a very constructive trend up basis with futures up 30, NASDAQ up 1.2%. I don't have my radar on Dow 35,000. I mean, John Ferro does.
Oh yeah, he's all into that.
He has the hat. Extrapolating out to 35,000. He's probably got the hat from the last time it was in there.
Yes, absolutely.
Coming up, Catherine Rooney Vera, a chief market strategist. We'll do this at Bulltech Capital Markets. Stay with us. This is Bloomberg again. Futures advance up 30 points.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky is in Brussels, the third stop on his quick trip to Western Europe. As he did in London and Paris, Zelensky is seeking more military aid for the war with Russia. European Parliament President Roberta Metsola said allies should consider sending long-range missile systems and fighter jets to Ukraine. Rescue crews continue to pull survivors from under the rubble of collapsed buildings in Turkey, but hopes are starting to fade more than 3 days after two massive earthquakes killed nearly 18,000 people in the country and Syria. The U.S. has positioned an aircraft carrier in the area for some assistance. President Biden is dismissing questions about his age ahead of what's expected to be a re-election campaign. In an interview on PBS, the president was asked about concerns some Democratic voters may have about his health and fitness. His response, quote, "Watch me, it's all I can say." President Biden is 80, the oldest president in U.S. history. British billionaire Jim Ratcliffe has hired J.P. Morgan Chase and Goldman Sachs to advise him on a bid for Manchester United. The English Premier League club has drawn takeover interest from Qatar. Manchester United is one of the biggest brands in global football. There's one estimate that it will sell for more than $4.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There's not yet much evidence, in my judgment, that the rate hikes that we've done so far are having much effect on the labor market. And we need to bring the labor market into balance. So that tells me we need to do more.
Neil Kashkari, with maybe the best understanding of Delta T at the Fed, the aerospace guy out of Illinois. He's always been interesting and is really focused on the X-axis. He's been supple. Can we say it's Kashkari the Hawk? Can we go there?
Kashkari the Extreme. Kashkari, I think that's a Kashkari on the edges. Maybe
one of the comments that we saw there was 14 Fed speakers. Today's not as stupid, right? Am I right?
We're not getting as many Fed speakers. I'm not going to play into that, Tom. Really? You're going to try to put that in my mouth?
Lisa Abramowicz and Tom Keene here, getting into trouble. John Ferro preparing for the next hour as he's
avoiding
trouble. To do. Yes, futures advanced. Can we just say that, there's an oomph to the market here at 846? I mean, maybe it's claims. I don't know. I got a, there it is. I've got a negative 85 basis points, 2-cent spread. We are not back to December 7th, but this is new 2023 inversion.
The reason why I think that the equity lift today is interesting is because it comes after the 1.7% decline yesterday in the NASDAQ. Have we reached the point where people are not in the let's just make it rally kind of mode or not? And this move that we're seeing ahead of today suggests people are still looking to buy more than they are looking to double down.
It has to do with the earnings as well. This is a joy. Right now, we're going to go down memory lane, which was that long ago and far away with a guy named David Malpass, who's got a job in Washington right now holding up a bank. There was, at Bear Stearns, absolutely definitive emerging market coverage. There was something about it in the air, in the pixie dust, and Catherine Rooney Vera was part of that. She's chief market strategist, head of global macro research at Bolta Capital. I've got to go back to Emmy Shio and David Malpass and all of it. What was it like? Is Bear Stearns literally, in my opinion, invented EM coverage on Wall Street?
Well, thank you for that kind introduction, Tom. And Bear Stearns was fun. It was a great place to work. And really, I miss it. But EM was a strong point. David Malpass, John Riding, Emmy Shio, as you mentioned, some of the heavy hitters. I was in emerging market fixed income research.
Yeah, okay.
And so enjoyed that time, yes.
But, it was a different battle. But then it was EM connected to the central, as Bill Rhodes would say, the central banker to the world. Is Jerome Powell right now the central banker to Emmy Shio's Latin America or the Pacific Rim? What's the power of our central bank leader now?
Well, emerging markets do very poorly in a Federal Reserve hiking cycle with the dollar appreciating in value. So that's why we saw emerging markets get devastated last year. And I think, Tom and Lisa, that's why we've seen emerging markets be the new darling year to date. It was one of the worst performers in 2022, and it's one of the top performers this year, precisely because it seems the Fed is maybe going to stop pretty soon. I still think it's a bit early to jump into that trade. I think that the momentum could carry us higher for the next month or so. But the Fed could do more, and more than the market is currently anticipating, as your guests have ad nauseum mentioned. But there's a certain euphoria, I think, right now for the riskiest paper and for the mean reversion trade.
Euphoria. Can you build on that? What is driving the euphoria other than just, I guess, positioning squeeze?
Yeah. I was talking with your previous guest in the green room, Winnie, and she called it, everyone's jazzed about the China reopening trade. And that's fantastic for emerging markets. China is a very important trade partner for Latin America, and it's very important as well for Asia, ex-China, right? So as China reopens, the surrounding areas, Malaysia, Thailand, those areas are going to get a bounce in tourism, and Latin America is also going to benefit. So I think there's that aspect. A weakening dollar is very favorable for emerging markets. Economic growth this year is going to be stellar in emerging markets. India, more than 6% growth. China is going to lead the growth. And that's going to be positive versus the developed markets. We're here in the U.S., in my view, we're going to be flat at best.
Well, but so do you think that, just to sort of put something concrete around this, do you think that right now the China reopening has been fully priced and even overpriced when it comes to how it's been represented in emerging markets, just riskier assets in general?
Yes, and I think that before I recommend going long on a sustainable fashion to institutional or even retail investors, we do have to see a pullback, a correction in risk assets. I think the U.S. recession is not priced in, particularly in the equity markets, and we have not seen difficulties with financing. There's a lot of names in the emerging space, as well as in high yield, that have not had those financing difficulties that I do expect to come to the fore as we feel the repercussions and the ramifications of 500 100 basis points in tightening in more than a year.
Two things right now, very important. You're lecturing at the University of Miami, and you're going to tell them we just had a new depth of inversion on the 2-10 spread, negative 85.298 points. 3-month 30 is at 107. It's not through to new depth yet, but there's the vanilla spread. What is the signal of new deep, substantial inversion?
Yeah, it's been really fun to be an adjunct professor at UM teaching global economics, especially, Tom, in this time in our lifetimes. Look, I'll go back to emerging markets again. They did their homework. Brazil increased rates more than 1,000 basis points last year alone. So I think that's part of the euphoria, plowing into these countries, these names, these geographies, these asset classes that are very juicy in yield.
Okay, I've got to ask Lisa. Lisa asked for me as well. Both of us tried to price a condo in Miami the other day and fell off our chair. You're living it. You're living the Florida boom.
I'm a beneficiary of it.
You're a beneficiary of it. Okay. Give all of our listeners and viewers worldwide a snapshot into the sustainability of the Florida boom. Can it continue?
The good news is that we have diversity both in, the diaspora from New York, New Jersey, and from Latin America. So all those people are coming. So it's not just the New Yorkers that certainly have bid up, not just my house price, Tom, which has jumped significantly in value, but also the wait list to get into schools. It's very difficult now to get into the private schools because of this influx. I think it is diverse. I think the mayor and the politicians there have done a fantastic job of enticing capital, and it's diverse in nature. So I don't envy you looking at real estate in Miami. I'm one of the New Yorkers that moved down, but thankfully 15 years ago,
Lisa,
when Bear
4
Stearns went
bedrooms,
under.
3 baths, and there's grass coming up through the driveway.
Yeah, we have a yard.
$2.5 million.
Basically, the most interesting thing that you've said in the not Florida real estate. I'm still looking at the 210 spread, which shows you how much of a nerd or whatever you want to call me. But I'm watching right now equities rally, continue to extend the rally, even though people pile into 10-year treasuries at a time when they're expecting more rate hikes. This doesn't add up. Do you understand this, Catherine?
No, and I think Victoria Fernandez said it very well. It doesn't add up. And so that's why I like T-bills. I've been saying this for an extended period of time. In fact, here on Bloomberg a couple months ago, 4.7%, 3-month, 6-month T-bills. It makes sense to me. I think it's a good idea to be in cash and cash equivalents. Some of my top picks in the equity space last year I continue to like, which are staples, underperformed this year, utility, energies, and healthcare in the equity space. And I think we do need to remain defensive under the expectation that this can't continue, right? We can't have record low unemployment in 53 years, productivity really kind of dismal, and labor costs still rising with the Fed getting to its 2% inflation target.
We're going to have to see. Thank you so much. Catherine Rooney-Vero with us
pleasure.
of Voltec Capital Markets, joining from Miami. It's good to have the Miami view. I mean, are you and I going to be the last two people here? Farrow's, I think, destined for Miami.
What, you think so? You think he's a Miami person?
Yeah, he's like, he's cut and chiseled, and he'd be.
Are you going to wear like a short sleeve polo with a bow tie?
It's not me. I went. I've been down a couple times, and
you're not a beach kind of guy.
No, it's not the beach kind of guy. It's just the Florida thing. I'm trying. I can't get there.
Yeah.
Lot of our guests have moved.
Yeah, and a lot of it's been some of the tax shift that they're doing too. I want to build on what you were talking about, the 210 spread.
I agree.
I think that's notable.
Seriously, folks, this is an historic moment right now that we're having.
What you're seeing is the deepest inversion there going back decades. We now reached a new low, not on an intraday basis, but on a closing basis, just to give you a sense. But what this indicates is that people are willing to accept that much lower of a yield to invest for 10 years than in the short term. Again, why is tech rallying in the face of this? Is it just that valuations still make sense? And maybe they do. I'm not saying they're not, but it raises a question.
I'm going to go back to Peter Fisher of Dartmouth and his public service to the nation, which is it's a 4-box prisoner's dilemma, and that the 10s are moving, the 2s are moving. You can have up, all down, or moving like this. On radio, this is really working out. But the answer is the ambiguity here is massive, Lisa.
Although the Fed's going to have to keep raising rates, and that has been the conclusion pretty broadly from the bond market.
Into the morning, into the next hour, futures up 34. This is Bloomberg Surveillance.